Continuing chapter 14, bottom of page 273, conventional, insured, and guaranteed loans. Conventional loans are originated by portfolio lenders. Those are lenders that lend their own money. These loans are directly between the lender and borrower with no third party involvement or influence. There's no third party involved whose lending guidelines they need to follow. And because of that, there is no involvement or influence from those outside sources because the lender is the one who decides whether they're going to lend their money or not. In these types of loans, the lender does not plan on reselling the loans, so they do have more flexibility. Government-backed loans would be some examples of that. Our FHA that's the Federal Housing Administration. They insure loans. You have the VA, that's the Department of Veterans Affairs. They guarantee 25% of the loan payment in the event of default by the veteran. Neither one of them lends money, and both of them require a special amendatory clause be added to their contracts that state if the property appraises below the purchase price, that the buyer can get out of the contract without penalty. And the NJHMFA, that's the New Jersey Housing Mortgage Finance Agency, they do not lend money directly. Once again, just the same, they have approved lenders to fund certain programs of theirs. So you get the loan from the local lender that's approved to fund their various loan programs. They have programs for first-time home buyers, people who work remotely, police and fire, yada, yada. And they do have loan programs. It's the NJHMFA that gives those 0% interest loans also for those who need to install water filtration systems for their well water, or let's see, they have programs that help with the closing costs, the down payment and closing costs. You could get one loan for buying the house and another one for the closing costs that you don't actually have to pay back if you lived in that house for at least 5 years. And these loans come directly from the government. The REC-D, they do their own funding. The REC-D is part of the U.S. Department of Agriculture. They give loans to people who live in rural areas. You guys are familiar with rural areas? I believe I told you once before what rural, suburban, urban, suburban, and rural is. But here is a little diagram I gave. Each one of these dots indicates people living there. So urban area is a densely populated area. We got a lot of people living close together, like in apartment buildings, high rises, in the city, and then suburban, suburbia, people live a little bit further apart, like with single family and two family houses. And then you have rural areas, which are sparsely populated areas. And this is like farmland or living out in the country. People don't live that close to each other. So let's highlight these on page 273. Conventional loans, government-backed loans. Those include those from the FHA and guaranteed by the VA. So FHA insures loans, you need to know, and the VA guarantees them. Neither one lends money, though. All right.
Wait 1 second.
Oh, yeah. So this third bullet point are those loans from the NJHMFA and the Rec D.
Okay.
All right. And then how lending works in a nutshell. This is my little write-up of that. You have most lenders, they don't actually lend their own money, but those that do, they're called portfolio lenders. They plan on keeping those loans within their own investment portfolios. The loans that they give, sometimes they're either referred to as either portfolio loans or conventional loans. And who do consumers get loans from? Well, when you go to get money, who funds them? Banks, credit unions, and investors. And some examples of these investment groups are those that are insurance companies, investment funds, etc. They're common sources of getting money. You know, insurance companies, they're holding on a lot of money. They don't just sit on piles of money until claims have to be paid out. They reinvest it. And as you recall, we can make a lot of money in charging low interest rates. You could still make a lot of money in lending it. So banks lend their deposit. Now, this statement is not really 100% correct, but it's easier for our minds to understand. Banks lend their depositors money according to some third-party investors' criteria. Technically, banks don't lend their depositors money, but just run with this for now. Banks lend their depositors money according to some third-party investors' criteria. These are what we call those lending guidelines. When you go in for a loan, they tell you if you qualify for the loan or not. Those lending guidelines, how do they come up with them? Well, most banks, they lend money with the intent not on holding on to them for the full term of the loan. They plan on reselling those loans, getting some of that money back and some of the interest paid. And then they write out another loan and do the same thing over again. So those lending guidelines are according to some third-party investors' guidelines who's willing to purchase them. If they write those loans, or if they originate them from the beginning, according to those guidelines, then they know that they could sell them in advance. So that's often what they do. So then they sell their loans later to get their depositors' money back, plus some of the interest paid up front as profit. And on top of that, they even get paid sometimes a servicing fee to continue collecting the monthly mortgage payments and render accounting to the investor who bought the loan. So when loans are originated to the consumer to buy real estate, they refer to this as the primary mortgage market. And where they resell those loans to investors, this is called the secondary market. That's all that the primary and secondary markets are. Primary market is where loans are originated to the consumer to buy real estate, and secondary market is where those loans are then resold. And I have these videos here, money as debt, how to see. It's like a cartoon version. It's like a movie. It's about 46, 47 minutes long. Money as Debt. This is a really good series. I think all teenage kids, once they reach that age, should see this. Even though it's based on a fictitious story, it gives you a good idea of how lending actually works, the whole concept from start to end. And here I could share this with you. Whoop, I can share these links with you to watch. Let's see this one right here. Let me pull up that link and I could share it with you. I'm not going to go playing it right now because we're in catch-up mode anyway. Okay, but here is how this, here's the video. This is Money as Debt. So conventional loans are guaranteed between those are guaranteed, and those are loans that are directly between the borrower and lender with no third party involvement or influence, because they're not relying on any third parties' lending guidelines that they need to follow. They have more flexibility in whether they're going to give the loan or not. Because it's directly between the lender and the borrower, and they don't have to follow any third parties' arbitrary guidelines to determine if they're going to grant a loan or not. So these loans, you either call them conventional, or because you get them from portfolio lenders, sometimes they're referred to as portfolio loans. So these are lenders who lend their own money with no intent to resell those loans. They plan on keeping them in their investment portfolio. That's why they refer to them as portfolio lenders or portfolio loans. And you should not confuse conventional loan with conforming loan. One that's conforming is one that meets a third-party lender's guidelines. So these loans are conforming loans are not directly between the borrower and the lender. There is a third party's lending guidelines that does have some say in whether they grant that loan or not, because they won't purchase those loans unless they meet their lending guidelines. So that's what we call portfolio loans. And Fannie Mae is the largest purchaser of conforming loans in the secondary market. The lender has the final say in who they're going to lend to in conventional loans, once again, because they're lending their own money and they're not planning on reselling those loans, so they have more flexibility. That doesn't mean that they make risky loans to people who have trouble getting loans. It just means that they could have more flexibility on certain things, like of you owning so many homes, or things that would not conform to third-party lending guidelines, like the debt-to-income ratio could be a little off, perhaps because you're an investor and you have a lot of write-offs on your taxes, so it doesn't look like you make a lot of money, yet you do. You're just taking advantage of that. Real world loan approval can figure this out. This is what you're doing here. If you got a bunch of loans that you're not behind on any payments, and yet you got a lot of write-offs like that, they can tell you're an investor and you're more stable and reliable, and not a risky person to lend to. The maximum seller concession is any money the seller concedes back to the buyer for things like repairs or their closing costs. So the maximum seller concession allowed on a conventional loan is 3% of the loan amount, not the purchase price. And this typically requires a larger down payment, 20% down, although I have seen conventional loans as low as 3%. It's up to the lender, I guess, to decide that. And if the LTV is higher than 80%, meaning that the borrower is putting down less than 20% of their own money, well, they're required to carry private mortgage insurance, or PMI. This is not insurance for the entire loan. It's not life insurance. It is insurance that insures the amount of the down payment when they put down less than 20%. So it's at least ensuring that 20% or the amount less than 20% that the borrower did not put down. Here's a list of local portfolio lenders you could see, and you can also find them on your own. If you ever drive by these large construction sites, you see that there's a banner out front. This project's funded by. That's usually a portfolio lender. They're lending for a type of loan that this may not have a normal type of lending criteria, so they had more flexibility in their lending. So you can usually tell that that's a portfolio lender. And here are some portfolio lenders. Even though even portfolio lenders usually lend money according to some third parties lending guidelines, because they don't keep all these loans that they originate in their own investment portfolio, but sometimes they can. And those would still be portfolio lenders. Okay.
Now, question, RSI doesn't exist anymore.
Rahway
So,
Savings Bank, yeah, they do.
yeah, well, I thought Columbia bought all of them.
When did that
I
happen?
thought they merged, they turned into Columbia's.
When did that happen? That must have been recent.
Within the last two, within the last year and a half.
So I still see the signs up there, Rahway Savings Institute on the banks. Huh.
Our RSI and RSI downtown is Columbia. The one over here on Linden Ave is Columbia.
And St. George Avenue, what about that one? That's Columbia too? Huh.
The one in Clark is Columbia. They're all Columbias now.
Yeah, there's one on
Yeah,
George
the
Avenue.
one on St. George in Linden Ave, on the
In
corner of Linden Ave, and that's a
closer,
Columbia now.
I'm not sure what street. There's a side street over there. I think it may be Roselle
It's
Street.
Linden Ave. It's no, it's Ross Street
Or Ross.
and Linden Ave.
Huh.
On one side is
I gotta,
Ross Street,
I
the
gotta
other
check them
side
out.
is Linden Ave.
Yeah, I gotta check that out. If I do, then I'll make that adjustment there. Okay.
Well, no, I bank there, so I know.
So
I
they
know.
change it. So they change it. Wow. I'm
Yeah.
surprised because they were in existence for almost 200 years.
Forever. Uh-huh.
Yeah.
And then
Yeah. So I'll check it out.
Columbia
Yeah,
bought
I'll
them.
check it out and see if
My
they.
mom passed last January,
Uh-huh.
and I had my business account at RSI, and I did my mom's estate account over there. So yeah,
Okay.
it's not
So they all the whole bank itself sold over, or just the
RSI
one the
anymore.
branch, or
No, all of them
they all sold that? Okay. Wow. Okay, that's interesting.
changed that
All right, I'll
from
change that
everything I
over
found.
then. Private mortgage insurance, PMI, once again, that insures the amount less than 20% that the borrower put down at the time that they purchase. So if the borrower only puts down 5% when they're getting a loan, the PMI insurance that the borrower would have to carry and pay for would only cover the other 15% of that 20% that they did not put down. It does not insure the entire loan. It just insures the down payment less than 20% that the borrower put down. Because conventional banking theory states that if a lender loans more than 80% of the value of the property, they're risking their depositors' money. So that's why they have to have that amount insured. So when equity reaches 20%, that PMI can be dropped at the borrower's request. And the lender has to drop the PMI insurance when equity is greater than 22%. They're allowed that little bit of leeway, that little bit of margin there, because property values fluctuate, and unless the borrower reaches out to them to let them know, they have that 2% leeway there, time to find out of that value's change. Now, so once again, PMI insurance is not life insurance and doesn't insure the entire loan like the mortgage insurance premium on FHA loans does. That's called MIP, mortgage insurance premium. Different than PMI, which is private mortgage insurance. PMI insures the 20%. MIP insures the entire loan of an FHA loan. And once again, what is equity? It's the difference between the current value on the property and what is owed on it. So let's highlight with any down payment less than 20%. This is page 274. Conventional loans must be accompanied by PMI, private mortgage insurance.
Oh. Okay. Wait, go back.
What, did you see me changing the slides here as I'm adjusting them and going in the background?
Yeah, they're changing, actually.
Oh,
They're
okay,
changing.
okay.
As you change it, they're
I thought
changing.
the regular screen was on there for you. Okay,
Uh-uh.
here you go. This one, private mortgage insurance. Okay.
Okay.
Oh, maybe it's focused on.
Okay.
You got that? And
Yeah.
the federal government requires lenders drop that PMI coverage when equity reaches 20% at the borrower's request, and they have to do it automatically when equity reaches 22. And we as real estate agents, we help lenders figure that out by doing brokers' price opinions for the lender if they're not going to get a new appraisal done. And it's similar to the CMA like we would do for the consumer. But either way, neither one of them are appraisals and should not be considered the equivalent of one. All right, so FHA loans, FHA insures loans, but they don't lend money. So it insures the lender for the entire loan amount. So the FHA does not lend money. They basically have some lending guidelines in place for that the borrower must meet and the property that they're purchasing must meet. And if these criteria are met, the FHA tells the local lender, lend the borrower your money. And in the event that they default on the loan, we will reimburse you every penny to make sure you don't lose anything. So that's what the FHA insurance does. So FHA insures loans. They do not lend money, though. So loans are for the purchase or refinancing of owner-occupied 1 to 4 family houses and single lots, single buildable lots. They're not for investors. These are for 1 to 4 family homes. Actually, I should not say they're for single family lots. They're not. 1 to 4 family homes, because it has to be move-in ready. They're going to lend you money to buy a house, not to build one. For that, that's a different type of loan, a construction loan. So this is a FHA loan is a loan to buy homes that are ready for that owner occupant to move into. So they're not for investors, and so therefore you're only allowed to have one outstanding FHA loan at a time, because you could only live in one house at a time. Right. So they're for 1 to 4 family homes. Now, the FHA 203B is the most common type FHA loan. It's a fixed rate loan, usually 30 years, but they do have up to 40, I believe. But the most common one is their 30-year loan. But FHA has a lot of different types of loans available. They have adjustable rate mortgages. They have construction and rehab loans available as well. But those have different names. This is the 203B, the fixed rate loan that most people use to buy real estate. And they have low down payment requirements of only 3.5%. So the LTV ratio is 96.5. The lender will loan 96.5% of the appraised value of the property. They have minimum repair requirements, but that the house needs to be in livable condition, not requiring a lot of repair. Like if the railings are loose or front steps are cracked or the paint is peeling, indicating a lead paint. It has to have an oven in the kitchen, and that oven has to work. It has certain requirements like this. And why you suppose they have that? Those livable condition requirements that don't require a lot of repair. Well, if you're going to be getting an FHA loan, it's probably because you don't have a lot of money to do them, right? You don't have a lot of money to put down when buying a house. So where are you going to get all the money to do repairs? So I guess the FHA looks at it like they're looking out for you, the consumer, by not allowing you to use the loan to buy a house that needs a lot of repairs. Even though a lot of people who buy homes wanting to use an FHA loan, they're like, they're the working class, and a lot of them may work in construction and be like, oh, I could do my own repairs. And so they want to use this, but the FHA says you can't. So they have a minimum repair requirement. Now, it requires an upfront mortgage insurance premium called MIP that is charged at closing. But the interesting part is you don't have to pay for it at closing. You can wrap it into the loan itself and then finance that cost of the insurance for the loan in the loan payment, which is strange. This is insurance for the entire loan. So if the consumer defaults, the insurance is what will pay off the lender in the event of default. And the monthly MIP payment is also required. And this can only be dropped if equity reaches 78%. During President Obama's term, when he was president, he changed this a little bit. And he said, he added in there that, well, that could only be dropped now if you had the loan for at least 11 years. And if you put down at least 10% at the time you bought the property. How much money down payment is required for an FHA loan?
3%.
3.5.
Oh, 3.5.
Okay.
Can you hear me?
Yes.
Oh, okay.
Yeah. So 3.5. But because of that, how much money do you think most people put down when they buy?
3.5%.
Yeah. So because of that, most people don't qualify ever to drop this loan. Then again, most people won't pay off 78% of the loan in the first 11 years anyway. But why did he put that in there? Well, he wants to make sure that people who use the FHA loan program to buy a house, to get into housing, that it's not a good loan for them to stay into for the long run. They should refinance it to like a 30-year fixed rate loan and get off the FHA program. Because if you default, then the FHA has to insure that lender against loss. And more loans that are out there that are insured like that, the FHA may be on the hook for if people start defaulting in mass again, like it happened during the mortgage meltdowns. Because at least half of the loans out there are FHA loans. So that FHA insurance program went bankrupt. And basically we had to have bailouts. Remember all the big bailouts? We had two of them, one under Bush, then another one under Obama. And this was, they gave a lot of money to the banks because they insured them against loss. Thing is, they should have put a requirement in there that if the banks take that money, that they had to follow certain rules about how they use it, but they did not. All right, so the maximum seller concession allowed for FHA type loans is 6% of the loan amount, unlike conventional loans, which it's 3%.
You said the maximum, what? You broke up. I couldn't hear you.
I said the maximum concession is up to 6% of the loan amount for FHA type loans, unlike the conventional loans, which it's only 3%. So the seller concessions usually used for closing costs and or repairs. Now it's up to 6% of the purchase price. Now any or all of the down payment and the closing costs may be a gift, not a loan that has to be repaid from the relatives. Now, the reason why it can't be a loan is because if it's a loan, you have to pay that back. And then they have to refactor your qualifications for that loan into your debt to income ratio and whatnot. So FHA loans before December 15th, 1989 can be assumed by anybody who does not need to qualify for the loan. Now, newer FHA loans are assumable as well. However, the borrower needs to qualify for the loan in order to assume it, to take it over. But then they don't have to pay for all those loan origination costs either. They don't need to get the house reappraised or do all that stuff. There's no closing cost on it because you're just taking over the existing loan. FHA 203K loan is a type of FHA loan that is a rehabilitation loan for doing improvements on a house, for maybe doing massive, extensive remodeling on a house. 203K, K for construction. I guess you can look at it that way to try to remember for exams. And that special amendatory clause that all FHA and VA loans require to have in them has to be in this. That basically says that if the house does not appraise for the purchase price, the buyer can get out of the contract without penalty. So for exams, you're going to need to know what that what's the purpose of the special amendatory clause that all FHA and VA loans are required to have in them. It says that if the house does not appraise for the purchase price, that the consumer can get out of the loan without penalty. All right, now FHA does have lending limits on how much money they'll lend to buy a 1, 2, 3, or 4 family house, and I have the guide of this around the country. There's a database here that you could access, and then also in order to get an FHA loan to buy a condominium, that condominium complex needs to be approved, that it's up to certain minimum construction standards, and that the majority of the units there are already owned in case it's a new complex, and that the majority of the units are owner occupied as opposed to renter occupied, because owners take better care of their homes and they're less likely to drop in value. So the FHA figures they're looking after the consumer there once again. But these FHA approved condo complexes, they need to be reapproved every 20 years. So you'll see on some of these lists that there may be a concentration of some FHA loans in these complexes. However, the complex is not approved now, but it can be reapproved again if somebody puts in a loan application and then works with the lender to get it reapproved, and also communicates with the condo management to get whatever's necessary. And anytime somebody defaults on an FHA loan and they get foreclosed on, those homes are then turned over to HUD to sell. That's what we call HUD homes. Those were homes that used to have FHA loans on them. They were foreclosed on, and then they're turned over to HUD. You can't call them foreclosed homes though, because they're not foreclosed anymore. Now they're owned by HUD. Technicality, but okay. They don't want you calling it a foreclosure. It's a HUD home. All right, so let's take a look at this NJHM. Let's take a look at these FHA loan limits by county. And if we were to look at this database, which I'm waiting for it to open here, double click. Okay. You can see it takes you to HUD's website. Can you see HUD's website, the FHA mortgage limits?
I see it now.
HUD website, okay. So if we're going to sort it by county, let's only look at New Jersey. So in the drop-down list, we'll select New Jersey. And we can see this is for the fiscal year of 2023. So let's just sort by county and all of New Jersey. And this is for 1 to 4 family homes. And you can see the county name here in this column. And this is a region name. Don't look at that. Look at the county name over here. How much they'll lend for a 1, 2, 3, and 4 family home, and what the median sale price is for homes, okay. Single family homes in that county. Okay, so Atlantic County is one of the cheaper counties. So you can see for a 1 family house, they'll lend up to $472,000, which is still pretty generous. Bergen County, one of the more expensive counties, they'll lend up to $1,089,000 for a single family house, all the way up to $2,095,000 for four family in Bergen County. Burlington
Wow.
County, it's a cheaper county, but a little more expensive than Atlantic. So as you can see, their loan limits are a little higher. So these charts will give you an idea of if your client can, if they're saying they're going to get an FHA loan, you could tell if they're going to be able to qualify for purchasing the loan that for the house that you wanted, that they were interested in purchasing, because FHA does have loan limits. And if the person's using an FHA loan to buy a house in Atlantic County, for example, a one family house, and it's more expensive than 472, then they could still possibly purchase the house, but they would have to pay that extra money out of their own pocket because the FHA is not going to lend it to them.
Okay.
Okay, so here's that chart for all the different counties, and you can see where they fall. Essex County is one of the more expensive counties. Hudson County is, Hunterdon is, Middlesex, Monmouth, Morris, Ocean. See, a lot of New Jersey's got expensive counties. Salem, those are more the rural counties that are in the lower than $1 million price range for a single family house, which is just insanity.
And
But
this is the amount that they will lend for these type of houses in these areas.
yep, for up to a one family house, this is how much they'll lend.
I don't see Union County.
Oh yeah, hold on a second.
Where's it at?
Right here, down the bottom of the list. You see it right here?
Oh, there it is. Okay.
Yeah.
Oh,
So
it's the same.
it's one of the more expensive counties, yeah. So, which it looks like the majority of the counties are the more expensive counties now in New Jersey. It's a lot of money, $1,089,000 for one family house.
Yeah.
We got some of the most expensive real estate in the country here in densely populated New Jersey, which is just insane because we got some of the most expensive taxes here as well.
Right. Tell me about it. Paying like 11 grand for my taxes.
Yeah, that's just insane. Normally, that's what a rich person would pay for their mansion,
Right.
anywhere else in the country. So this just gives you an idea how when we spoke about the tax chapter and like tax breaks that President Trump tried redoing, it just goes to show you how under normal circumstances that would be fine. That he gives tax breaks to people with homes up to $10,000 taxes, which is generous in most places in the country, except for those overtaxed areas. And in those instances, he says, well, then you need to talk to your politicians about it because you should not be getting taxed that much. They're mishandling your money if they keep charging you that much in taxes. Where's it going?
Right.
And he's right. That's a lot of freaking money, from all the residents that own homes in the state.
Right. Right. And we shouldn't be in the state that we're in.
Yeah.
With all the money that we pay.
That means where's it going? So
no, it's true.
Let's start doing some of the highlights now for FHA insured loans. So I'll show you the bits and pieces all over the places on page 274.
I got that one.
Okay. And then 274 as well.
274.
Under 203B.
203B.
A little bit halfway below the bottom of
yeah. Wait. second. Where's my pen? Where'd my pen go? And this is the refinance. %. Okay.
All right. And
Yep.
then this is on page 275, continuing FHA stuff to highlight.
My highlight is trying to die on me.
Uh-oh.
The FH.
Yeah, in my classes, you got to have at least 2 highlighters, you know.
Yeah, I did. The first one died.
Yeah,
3.5.
got to get them fat ones, them Sharpies.
Yeah, that's what it is. The FHA. Is this the right one? Cases, FHA. Different counties. Wait a minute.
Yeah, remember the
FHA.
database on the previous slide or 2 slides ago? I showed you where all the counties, there's different amounts that they'll lend, loan limits by county. You have to see the HUD website for that.
Yeah,
I gave you the link for that, right? Or did I just show
but
it to you?
this explanation. Yeah, it's in here. This explanation though in the mid part of on page 275, after cases, it stops. It's
Oh
I
yeah,
don't see the rest.
I'm sorry. This is stitched together. I think from the next page. Oh wait, no, this is same.
No,
So
no, no.
see HUD
It
website.
stops. No. See where it says country?
Estimate of value. Okay. Oh wait. Okay, yeah, this version of the book, it's a little bit different here. It has 580.
Where it said come down.
Yeah,
It
this
says the
paragraph.
FHA
Yeah,
sets top limits. Yeah, it doesn't have the rest.
yeah, it stops
It
right here. Yeah.
doesn't have the rest of that explanation in the book.
Well, the mandatory clause was mentioned someplace else in here. I'm pretty sure. Let me just snap a picture of this so I could add the right one here, so you don't get confused. Yeah, but it was you already highlighted it someplace else though about the special and mandatory clause in this chapter.
Yeah,
Uh,
but there's nowhere for me to highlight the rest of it. Loan limits.
yeah, well, that's just talking about the FHA that contingency clauses. See that a mandatory clause that has to be added to the contract that says if the house is not appraised for less, if it doesn't appraise for the purchase price, then the buyer doesn't have to go through with the purchase. That's all that is. Remember me going over that a couple times? I think that was
Okay, I'm
even,
gonna take a picture of it,
yeah.
so I'll have it. Minimum repairs allowed. Okay, I got it. I got everything.
Okay. Yeah, I'm just snapping some pictures to get the any changes of the wording in the book here. See how they made mild changes to the version of the book? But this information's still in the book, and we already highlighted it a couple times somewhere else, but yeah. Okay. So let's see, the occupancy requirements, just write maybe FHA loans, and then highlight may be assumed. Doesn't matter when they're originated, they're assumable. That's what I want you to know. The only difference that they're going over here in the book is that the older loans, the person who's assuming it doesn't need to get approved, but the newer loans, the borrower has to qualify to the lender standards.
This is FH. Oh, this is page 276. Okay, wait a minute. Hold up. Mandatory clause. And what does this say? Can get out of contract without penalty. Okay.
See, that's, they just relocated it. So I knew it was still here in the book somewhere.
Yeah, on the other side.
Yeah.
Out. Okay.
And that's that whole thing that you missed out on the previous page about the house having to appraise for the purchase price, or the buyer can get out of the contract without penalty. All right, I could change slide.
Yep.
Okay, that was, yeah. Here's that picture of a house around the corner from my house, where they did tear down the entire house. Now, I'm not sure if they used FHA loan for this, but I've seen people use FHA loans and do this and use this as an old builder's trick. Otherwise, why would you keep part of the original house there? Basically, they tear down the entire house. In this case, they even dug the basement out deeper and further towards the back to make the footprint of the house bigger. But they left one original wall of the house standing. I mean, this one, they actually tore it down eventually. They're just waiting for the power company to disconnect the power to the house. But they left the garage here standing. You see here, here's a better vantage. They tore down the entire house. They just left the garage and this one wall standing, where they eventually tore that down too. And they built the whole new house around the garage.
Okay.
And then they built this there in its place, and that's still during the construction phase. As you can see, the sidewalk's not catching up to the thing there. Now it is. They put up a new sidewalk. And look how this house is a monster compared to the neighboring homes, in the neighborhood. This house is about 3.5 times the size of these.
Right.
So as far as
they built up and out.
And down. They dug out the basement deeper too, so they got those 10-foot tall high ceilings in the basements too.
It looks so awkward.
Yeah, but they built a house. They built another monster house like this across the street, but it's a nicer looking house as well. They did the same thing across the street. But this is still in the construction process here. They weren't finished with the repaving the driveway or grassing it up or anything. It was this. So this is still. I don't like these windows. Here's an aerial view. Look at the size comparison.
Oh my God. Oh my God.
Yeah.
And that house to the, well, if you're facing it, the house to the left is fairly large compared to the house to the right. And that house is two
It's
of those houses
yeah,
together.
it's still dwarfed by its size, you know. This house over here, these are both still same architectural style.
Right. In the front, they're all the front.
Yeah,
They're all the same in the front.
yeah. So this one, that's funny though, because it's still the second floor still got a dormered roof. Over here, the second floor is a full second floor, then a dormer on top of that. So this is one, two full stories, and then a dormer on top of it. This is one story, and the second story has a dormered angled roof. You see that? So I mean, this house is much bigger than the neighboring houses, but they don't got much backyard.
Nothing.
They
I
built
noticed a lot.
all the
I
way to
noticed that a
the,
lot.
yeah. Go ahead.
I noticed that a lot lately that they're building these houses around in Linden and well
Mhm.
they not too much in Rahway, but in Linden they're building these houses. They're huge, but they have no land around them.
Yeah, it's amazing that the city's building department's allowing that to be done too. Because there's a house on the other
Or
corner
letting them do that.
of my street
Well,
that
they
they're
collect more
looking at.
taxes off of them, don't they?
Well, the thing is, this is an old builder's trick. Because they built the whole house around the original garage, it doesn't look like it's a new construction. So if you look at the tax records for this property, it still shows built in 1955 or whatever it was, uh, remodeled in 2021. I believe they built this one. So it's an old builder's trick. So the tax man and the building department, they don't communicate with each other usually, you know. And the tax man, they would only know that that the taxes should be increased hugely on this if it's new construction, you know. But as far as they're concerned, this is still a 1955 house. As far as they're concerned, it's a house like this that was just had some remodeling done to it. I mean, it'll eventually catch up to them a little bit, but they got quite a few years they could get out of there without the tax man knowing about it. So that's why they wouldn't tear down the whole entire thing. They'd leave one original wall standing of the house, because then technically it's not a new house. It's an old builder's trick. And the majority of the towns, municipalities in New Jersey, they don't, the builders department don't communicate with the taxing department, usually, even though they're right next door to each other, the doors, or across the hall from each other. It's funny.
Wow.
Nobody ever
So
City Hall being smart or efficient.
so would it ever be a situation as to where they found out what the renovations were and they go back and tax you, or they have to tax
They,
you from where it started?
no, they can't. They can't go back and tax you for what it was. That was them that was taxing. They had the availability. It wasn't being hidden from them. They got the permits and did everything they were supposed to.
So what happens if you don't close out a
Well,
permit then? Are you supposed to close out is it the homeowners? That was always a question of mine. Is it the homeowner's responsibility to get the permit, or is it the people that's doing the work's responsibility to get the permit?
well, the homeowner will usually rely on the builders to get whatever permits are necessary to do the things, but ultimately it's the homeowner, it's their property, so it's their responsibility to make sure the proper permits are filed for
So
any.
if the permit is never closed, or like, then they come after the homeowner.
Well, they can't move. They can't move in the house unless they got the permits
But if
closed out. So what you're talking about is you got to get a permit to do any demolition or construction, and then before a property can be occupied, you got to get a certificate of occupancy showing that all the construction's up to standard and that all the work was done properly.
see, like with my house, we had a permit, we had a 203K,
Hmm.
and and I was able to, I had got my CO before. Well, I do believe I have my CO because I'm still living here. Um, but we had a permit, and I know we went through two contractors, and I don't think the permits were ever closed out.
Well,
So
if you got the CO that you did, because they get a permit to do the construction, and then when it gets closed out, what you keep saying getting closed out means that the city inspector came back to inspect to make sure all the work was done properly, and then they issue a certificate of occupancy. So you got that certificate of occupancy that allows you to occupy the premises now, then those permits were closed out.
I don't
Okay.
know. Okay. All right. I don't know.
Now, that was interesting, huh? So so even with those FHA 203K loans, let's back up there for a second. Those FHA 203K loans, they're for extensive remodeling. Some people use it to put an addition on a house or build a garage or just remodel their kitchen. But who says you can't do this? That's extensive remodeling. Very
Yeah, but
expensive.
there's two different kind of 203Ks. They're two different kind of 203Ks. There's the standard and there's that the second one where you knock down walls and structures and stuff like that. But they won't lend up to a certain amount
Well,
to do all the rest of that.
how much will they lend you?
For the standard, depending on what
They'll lend you based on the after repair value.
your loan is, up to 30,000.
Well, it's based off of not a dollar amount. It's based on the, well, it is a dollar amount, but it's based on the after repair value. So an appraiser has to, you have to submit your plans for the work that you want to get done to the FHA. And the appraisal will have to, the appraiser will have to say, give an estimate of not just what the current value is for the entire home, but what the after repair value would be. So they're not going to lend you more money than the after repair value, because if you're going to be doing an addition and building up a house like this, obviously the after repair value is going to be significantly higher than it previously was when it was like this, right? So that after repair value, they'll lend you up to that as long as they know that the collateral's there in the event they needed to foreclose. So it's based, those 203K loans are based on the after repair value model. It's based on the repairs or the improvements that you're doing have to be worth it, they're not going to lend you more money than what they'll be able to collect if they needed to foreclose on you. So the value, the after repair value has to be there. So since you got an FHA 203K loan for your house, you know that they give you one loan to buy a house and another to do the improvements, but they're not giving you a check for doing the improvements and hoping that you do the improvements. They pay contractors in phases as the work is getting done, and they pay the contractors directly. So
that's how it's supposed to go, but the check is in your name and the contractor's name. It's
yeah,
not just in the contractor's name. It's
Yeah,
supposed to go like
you can't go
that.
cashing that check and then go doing whatever you want with it.
Well, no, what happened, well, for mine is I had two different contractors that bailed on the job. So then the third time before the last draws were done, they allowed me to be the contractor of record and do the work myself.
Because you were experiencing issues.
Right. So even with that, it's all one
Yeah.
loan. It wasn't like two separate loans. It
Yeah.
was all one loan. And even when I tried to get the loan, since I was a police officer, I used to do a lot of tax write-offs.
Well, this is usually paid out in phases.
So because tax write-offs, they look at tax write-offs as income.
Well, this is usually
it's supposed to be paid out in 4 draws.
Yeah, as certain levels of the construction are done, when you submit the plans, they'll say, okay, when the work is done up to a certain point, then we're going to have to send out the appraiser to make sure to confirm that work was completed up until everything that was stated in phase 1 of the construction. The appraiser will have to go out and confirm that all that work was done, and then we'll release the funds for that first phase of the construction. Then you could start.
Right. That's all theory.
Yeah. That's the way it's supposed to.
When it's written down, and then when it's actually applicated, it's two different situations.
Yeah. It should have been done that way anyway.
Right. Exactly.
Okay, so now we also have VA loans. These are for veterans. They formerly called them GI loans. That used to be what we called veterans, GIs. That stood for general issue. Everybody got the same same uniform, got the same gun, got the same bullets, everybody got issued the same thing. There was no fancy, it wasn't about you as an individual to be able to express yourself like they say in the commercials now where they're trying to recruit people. You could be yourself. Now they push all this stuff that's more about emotions. In the past it was more about your patriotism. Yeah, general issue, join the military. We'll make you a better person. We'll sculpt you into a better person. But listen, you all got to follow the same rules. You all wear the same uniform. You all get the same gun. Now it's like a lot different these days. That's why they're having trouble meeting their recruitment requirements, I guess. But it was formerly called GI. Now it's just VA loans. Okay, that's the Department of Veterans Affairs. These loans are intended for veteran or veteran owner or veteran co-owned and occupied 1 to 4 family homes. So once again, it's not for investors; it is for veterans. And so you could only have one outstanding VA loan at a time as well. So VA loans are VA no longer has lending limits now. Not sure what brought that on. But they used to have lending limits, just like the FHA loan in the different counties throughout the country. Now, it's no lending limits, but the VA will guarantee 25% of the loan amount, provided that the property is at least valued at $144,000. Therefore, that veteran can still get 100% financing because the VA is guaranteeing 25%. It's as if the veteran put down 25%. No private mortgage insurance would need to be carried then, and none of that stuff, because it's when you put down at least 20%, that's how it works. So if the government the military is guaranteeing 25% if that veteran defaults, it's as if they put down 25%. Because the lender can be guaranteed that they're going to get it in the event that they default. So these are usually 100% financing, and the lenders usually don't require any additional money to be put down by the veteran, although they could if they want, since they're lending their money and they decide on who they lend to. But usually VA loans are 100% financing, although the veteran can put down money, of course, but they don't have to. And they do also have that special mandatory clause, just like the FHA loans do, that they say that if the house is not appraised for the purchase price, the veteran can get out of the contract without penalty. The appraisal for the VA loan is, this we need to know for exams, it's called a CRV, a Certificate of Reasonable Value. Sometimes a lot of students, they tend to remember this better if I tell them just to relate that to the Honda CRV, one of the more popular SUV vehicles there, or cars. The Honda CRV. What do we call the appraisal for a veteran's loan? And they just think of that, the Honda CRV, the car, CRV. And for some reason, people tend to remember it a lot better that way. But either way, it's a Certificate of Reasonable Value, CRV, and you'll need to know that for exam. Discount points, they can be paid by the seller, buyer, or shared between them. There's a funding application fee that the veteran has to pay, though. And that application fee is higher for the National Guardsmen and reservists. They pay higher funding fees. Those fees can be totally waived for disabled veterans and whatnot. Now, VA loans can be assumed by anyone who does not need to be a veteran. Often that's a state exam question. Do you need to be a veteran to assume a VA loan? No.
Oh, I thought you had to be.
Okay, you need to be a veteran in order to get a VA loan, but not to take one over. To assume one, you do not.
So someone could have a VA loan and I can assume that I can just take over the loan?
Yeah. And you don't need to be a veteran. Mm-hmm. Now, what is the eligibility requirements for those who served in the military? Well, you have to be either active duty or a veteran, and served at least 90 consecutive days of active duty during wartime, which is interesting because we haven't had a war in a long time. All the conflicts that we've been in, that's what they refer to them as, conflicts or peacekeeping missions or what have you, but they don't call them wars because only an act of Congress can declare war. So technically, we haven't been in a war since World War II. All those wars that we've been in ever since, they haven't really officially been wars. they've been
Right.
they've been conflicts. So it's interesting how veterans get their benefits still, but they have to serve 90 consecutive days of active duty during wartime, 181 days of active service during peacetime, or 6 years in the reserves or National Guard, which is interesting because we have such a low recruitment. We're not meeting our recruitment target levels. And we have seen National Guardsmen and reservists sent overseas to serve, and they're like serving on front lines of military operations. And they're not really considered, full-time military personnel. But the rule is they should be if they served at least 90 consecutive days during active duty during wartime. Now, are they getting their benefits because they're serving their front lines in these things that are not considered officially war? I don't know. I'm not sure about that. I know I have veterans in my family, but they weren't in the reserves or National Guard. They were in the serving either with Navy or the Army or Air Force or what have you. So it's I don't know for sure. Or are they just getting screwed? I don't know. Okay, so they used to have VA loan limits, and that's probably why I couldn't find those VA loan limits anymore, because they don't have them. It's 100% financing. There's no top dollar amounts as long as the property is valued at least $144,000, and the veteran has to qualify for the loan. There's no top limit on how much they'll lend. Let me see where this link takes you now, by the way, because it used to be loan limits on VA loans. Take a look now. As of 2020, you have full entitlement. You don't have VA loan limits. You have full entitlement. You don't have a loan limit. I don't know why they require a minimum of 144,000.
Hmm.
I don't know where they got that from because
I was about to say it's so specific.
because some places in the country you could buy a nice house for under that. So I don't know why they would put that minimum there. Unless they're trying to jack up the values all over. All right, I don't know what that's all about. Okay, so they don't have any loan limits anymore. All right. And as always, I always when there's something that's related, I'll bring it up. Now, not so related, but I guess we're talking about the military, and I bring up movies often that are real estate related. This is not real estate related, but they're talking about veterans, and here's a funny movie about the military called Stripes. Remember that one
Yeah.
from the '80s with Bill Murray? So
Mm-hmm.
I throw that one out there for people. You'd be surprised how many people never heard of it.
Yeah. Well, you got a younger generation
Yeah,
that don't that
they're
don't
missing
know.
out. They're missing out on the old
They
comedy.
have they have no idea.
Everything's got to be an extreme, either gratuitous sex and violence.
Right, right,
There can't be
right.
comedy involved in the middle. Yeah. All right. So here we go, page 276. This is not an exact printout from the book here, so I obviously made some. Wait, is this one very similar here? Let me see. Single family homes. Yeah, this is from this book. It's still the same.
Let's see. The Department of Veterans.
Yeah, this is the same as the printout from this book, too. Nothing changed here, really. but some things changed from a previous version book. So I made some notes here that because they didn't write down some of these important things, I wrote them. You could write them. I wrote it up here actually in mine. I wrote guarantees 25% of loan, no down payment required, no lending limit, can be assumed by non-veterans.
Okay.
So here, this is, I wrote all this up top. I squeezed it here, but you could write it in the margin or wherever. VA has no lending limits. VA can be assumed by non-veterans. Guarantees 25% of the loan, no down payment required.
25%.
Yeah. The more important things to write there, guarantees 25% of loan, no down payment required, no lending limits, can be assumed by non-veterans.
Okay, wait, that was that part. Now look,
I'll leave it up there. You could
let me see.
copy that over.
See. Oh. Okay. Oh, wait. Okay, VA appraisal, I got that right there. And the FHA penalty.
Hmm.
No, I'm just limits.
We're on page 276 for whoever just popped in there. We're just putting in the notes there for VA loans. We're writing here on the side. No lending limit, can be assumed by non-veterans. VA guarantees 25% of the loan, whereas the FHA insures the loan, and no down payment is required.
Can be so. Okay, so now here we go. Here. No.
Take your time. Just let me know when you're when you got it all there.
Okay. B. Okay. I got that.
Okay. Yeah. Okay. Yeah.
I'm not done yet.
You still writing?
Yeah.
Just unmute yourself and let me know when you got it. I did mute everybody. There was a little background noise, so I muted it out.
All right, Olga.
All right. So the NJHMFA, that's the New Jersey Housing Mortgage and Finance Agency, they give loans to people who live in urban target areas. What is an urban target area? Once again, it's a densely populated area, like the city, where there's high rises, there's apartment buildings, a lot of people living within a close proximity of each other. The NJHMFA offers below market interest loans with very low rates, requiring little to no down payment to qualified buyers, not investors who are owner occupants who live in urban target areas. Even though you apply to get the loan and the loans are funded by approved lenders, approved lending institutions for their various loan programs, they have a lot of programs available for first-time home buyers. That was formerly called the New Jersey Smart Start program. They also have programs for people who live where you work, who go to work in off-peak hours, trying to relieve the busy congestion on the New Jersey roads. Police, fire, teachers, they all get there's special programs available for all of them. All right. And then we also have, let's see, they also have an additional loan that's available for the down payment and closing cost of the house. If you get the primary loan to purchase the house through them, they have a secondary loan that you could get for the down payment and closing cost that does not need to be paid back at all if you live in the house for at least 5 years. That's their we'll go over that and how that works in the coming slide. So some resource here is 1-800-NJ-HOUSE is the number for the NJHMFA. Here's a link to the consumer's site, njhousing.gov. And they also have bank-owned properties that they foreclosed on. And here's the link to that. And then they also have webinars available for home buyers that teach them about the home buying process, getting the loans, etc. You can see that right here. So New Jersey Housing Mortgage Finance Agency, let's do these highlights, offers below market interest loans with little to no down payment, requires no qualified buyers to purchase homes in urban target areas. So with low or no down payment for those who purchase homes in urban target areas. Outside these target areas, the loans could still be available, especially to the first-time home buyers. And let me know when you got that, gang.
Olga.
So that loan that they give you for the down payment and or closing costs that you don't have to pay back if you live in the property for at least 5 years, they call that DPA, Down Payment Assistance Program. It's available for first-time home buyers. And a first-time home buyer is defined as somebody who did not own a home in the last 3 years. Borrower's income cannot exceed 140% of the average home, the average income for qualifying for the loan. A second loan for $10,000 to $15,000 of down payment assistance available that you don't have to pay back, but it has to be combined with one of their other loans. The buyers must take a class, or at least that's the rule, the way it used to be. I'm not sure if it still is now, guys. So buyers in the past, for first-time home buyers, they had to take a class to teach them how to balance a checkbook and do basic repairs. It's like a one-day class, to, you know, how to change an air filter and an HVAC system, things like that, how to do change a washer in a sink, you know, basic repairs, so that the homeowner is not likely to lose their home because it ends up being too expensive because they got to hire a professional to fix everything. So they show them how to become a responsible first-time homeowner. And then a second home loan at 0%. So it's a second loan available at 0% interest rate that is forgiven. You don't make any monthly payments back on it as long as you live in that house for at least 5 years. But if you sell the house in less than 5 years, then there is an interest rate on it, and it is higher than prevailing. So if you lived in the house for at least 5 years, you pay none of it back. You sell the house within 4 years, you pay 25% back. 3 years, 50, 2 years, 75, 1 year or less, you pay all of it back. So they also, NJHMFA also has other programs available. Their 30-year conventional loan, 30-year fixed government insured loan, the 30-year fixed government insured loan, the homeward bound. I don't know the specifics of the differences between these loans. You'd have to check with them. They either renamed the loans or change them up. So you got to really check and see what the differences are between these loans now. And they have those pension fund for the police and fire and teachers. So they get those, they have loans available for them as well, and that down payment assistance program. So here's the contacts for them: 1-800-NJ-HOUSE, njhousing.gov, or theroadhomenj.com. That's more targeted towards the consumer for educating them on the different loans and the home buying process. On these slides, I have, you know, slideshows and frequently asked questions, home buyer's guide, which I gave you previously in a different chapter. Here's a link to that loan for the people who have well water, where they could get those 0% interest-free loans to install water filtration systems in their homes. And then lastly, we have the REC-D. That's the Rural Economic Community Development, formerly called the Farmers Home Loan Association. So either way, it's a part of the USDA. These are for owner-occupied 1 to 4 family homes, not for investors. They're for low-income, first-time buyers, farmers, or just people who live in rural areas. These are subsidized loans that you could get at interest rates as low as 1%. They're for modest priced homes in rural areas. What is modest priced? I'm not sure. I mean, look, the FHA gives loans up to $1 million for a single family house, you know, so what is modest priced? I'm not sure. The loans directly from the Department of Agriculture, the USDA, and you get 100% financing even today. 100% financing, no money down, that means, with as little as 1% interest rates if you buy a home in a rural area. Now, no place in Union County or Middlesex County is considered rural. However, Somerset is. Actually, a lot of Somerset is considered rural. So right there, you go through New Brunswick, and now you're in, what is that, Franklin? You know, even though that immediate area of Franklin seems like it's urban, it's actually classified as rural within Somerset. So you could get 100% financing with as low as 1% down there, or 1% interest rate. So you'd have to check with their population rural classifications are. What do they consider to be rural? Let me see if there's a map there now or something. Let me just check this link out real quick. Maybe you put in an address and it'll tell you if it's a rural area. Just the words on it. Previously, they had a map you could click on. And you could zoom in on areas, kind of like a Google map. Maybe not anymore. This is what it is now. That's just charts. Previously, it was like Google Map that you could type in an address and you could zoom in on it. All right, whatever. Not important. All right. So, Rec D, formerly called the Farmers Home Loan Association, gives loans to people in rural areas, right? Who gives loans to people in urban target areas? The NJHMFA. Okay, so the former Farmers Home Loan, now called the Rec D. These loans are funded by the USDA, the Department of Agriculture. Yeah, the people that inspect your meat and your food. Yeah. So just highlight that. They give loans in rural areas, loans funded by USDA for rural areas. Yeah, mortgage interest rates subsidized as low as 1%. Let me know when you got that. Somebody bailed on us. All right. You guys have that already? Should by now. And that's the end of that chapter. Next, we'll do the key terms to review. All right, let's do key terms to review for chapter 14. Mortgage payments can be taken over by the next buyer.
Assumable loan.
3 is A, assumable loan. The highest interest rate ever allowed on a specific adjustable loan.
Cap.
The highest, remember you got the cap down here?
Oh, the ceiling.
Ceiling, hey. 7 is B. A repayment plan, the equivalent of 13 monthly payments per year.
13 monthly. Biweekly mortgage?
Biweekly mortgage, 4C. A plan with interest rate periodically changed up or down.
It's adjustable rate mortgage.
1 is D, yes, correct. A written estimate of value by a real estate licensee, not an appraiser. Or not an appraisal.
A written estimate of value. Certification of reasonable value?
Nope.
No.
Appraisers do those.
Okay, wait. Written estimate not by an appraiser.
Yeah, written estimate of let me see. Written estimate of value by a real estate licensee. That's us.
CMA.
CMA 8 is E. The repayment plan of principal and interest that gradually reduces the debt.
Pay down.
It fully kills it off.
Amortization loan.
Amortized loan. Yep, 2 is F. Percentage beyond which interest rate cannot be raised at adjustment.
That's fixed. Wait. Percentage rate is a fixed.
The percentage rate beyond the percentage beyond rate cannot be raised at adjustment.
Percentage rate beyond.
Wait, what letter are we up to?
We are on number G.
To G. Percentage beyond which interest rate on adjustment. Is that 9? No.
The highest rate can go up in any single adjustment period.
Percentage rate beyond which interest rates cannot be raised at adjustment.
I'm not sure.
Cap.
G. Hey, Ray, I think you're up a little bit. Turn your volume down so it stops the feedback.
Better?
You got it?
Turn it down. Is that better?
Okay. You can still hear it, though, right?
Yeah, I still hear it. I think that's coming from your end.
I didn't have any feedback before you came in.
It's between the two of you, I think. The feedback between you, Victor, and you, Raymond. It's your feedback with each other. Because now I can even hear me. Where I couldn't.
I just muted my mic and I still had the feedback when you were talking.
So then, Raymond, you gotta turn something down.
Yeah, just turn the volume down. Is it still high?
There we go.
It's better.
Wow. Yeah,
It's still an echo, but it's better.
There. It's weird. Maybe it's the placement of where speakers are in relation to the microphone. If you go to the if you go to the microphone settings here, I'm muting everybody, and you see there's no feedback now. This is because I muted everybody's microphone, so it's not feeding back in. If you, it's probably the position of where your microphone's located in relation to the speakers. But you could also go to your settings in your microphone, and there's this audio setting. If you go to the audio settings, that would prevent feedback. It basically cancels a lot of background noise and probably the speaker noise that feeds back into the speakers. Anyway, so we were on, we did G, so 6 was G. Okay, payment of extra points in return for a lower interest rate. Just press your space bar down, Raymond, when you need to talk again, because that'll temporarily unmute you. Okay? The payment of extra points in return for lower interest rate.
Pay down.
The buy down. Yeah, 5.
Buy down. I'm sorry, buy down.
Yeah, 5 is H. The difference between the current value and money owed.
Equity.
Equity, 10 is I. And VA appraisal statement.
J. I mean,
Yes.
certificate of reasonable value.
Yep, certificate of reasonable value, 9 is J. Okay, let's do key terms 2. A loan guaranteed by the federal government. Who guarantees loans in the federal government?
VA.
The VA guarantees 25% of the loan amount. 10 is A, correct. A protection for lender on low down payment conventional mortgages.
A protection for lenders on a low down payment. No. I'm not even reading these things.
Protection for lender on low down payment conventional mortgage. When you don't put down a lot of money, what is that protection for the lender?
PMI insurance.
PMI insurance,
PMI.
7 is B, correct. See, sometimes you got to reread the statement or in your head to, and like,
what makes sense?
yeah, to how it makes sense to you, you know, because they word it weirdly sometimes. Mortgage payment, including amortization, interest, and certain expenses. Mortgage payment, including
PITI?
amortization, interest, and certain expenses. That would be PITI. You said that, right?
Yes.
5 is C. That includes principal, interest, taxes, and insurance. So let's see. Percentage of property's value that may be borrowed.
Loan to value.
Loan to value.
4 is D. Yep.
Come on, Raymond. I hear you.
Lender agrees to hold the interest rate for a certain period of time.
Lender agrees to hold the interest rate for a certain period.
Yeah, remember I told you that you had to take that, snap that picture of that slide because it was totally removed from this version book. It was on the rate lock.
Rate lock. I was about to say rate lock.
Okay, 8 is E. 1% of the loan charge as an upfront interest when the loan is paid.
Interest when the loan is made. Straight loan? Oh, point.
8 point. Yes, 6 is F.
F is 6.
Correct.
Okay.
Low down payment insured mortgage loan.
Low down payment insured. That's a straight loan.
What do we call down payment insured mortgage loan? What kind of loan is insured and requires a down payment?
FHA.
1 is G. The FHA 203B.
Oh, I thought. Okay.
Mortgage
So
loan.
FHA loan isn't it like what 3.5% down payment?
Correct.
Yeah, but when it threw me off when it said 203B.
Yep.
I thought it would have something to do with
Well, hold on a second. So FHA loans, they require low down payment, only 3.5% down payment requirement. FHA 203B is the most common type of FHA loan. It's a 30-year fixed FHA loan. Remember, we got FHA 203K, but the 203B is the most common one. So what did this say? 1% of the loan. Oh, no. Low down payment insured mortgage loan. So 1 was G. Yeah. Because there is no 203K here in this section. All right, so
I read it wrong.
yeah.
When I saw 203B, I was thinking of 203K.
It's all right. Mortgage with payment of interest only. What do we call an interest only loan?
Straight loan.
9 is H. Charge for the use of other people's money. What's that fee that you pay for the use of other people's money?
Interest.
Interest. 3 is I. And a guide to national mortgage trends used for adjustable rate mortgages to determine if the rates are going to go up or down.
J.
Yep. Tie it to some sort of a. Just said it.
J. What?
An index. 2.
Wait a minute.
2 is J.
Yeah, 2 is J. Okay.
You got to tie it to some sort of an index. Okay, so that was 2 was J. Okay. That concludes chapter 14. So chapter 15, financing two primary and secondary markets. In this chapter, we're going to talk about financing techniques. We're going to talk about the primary market versus the secondary market and get more into that and what that's all about, as well as disclosures of certain documents and such during the lending process. So how lending works in a nutshell: banks lend their depositors money with the intent of reselling those loans, getting the money back, plus some interest, and maybe even collecting a servicing fee. And that's how they earn their money. And then they lend them, and then they write a loan again. So most lenders do not hold on to loans that they originate. They resell them shortly after they originate them, so that they could get all the money back plus some of the interest. And they don't keep the loans out there for long periods of time. They originate the loan, they sell the loan, they get their money plus some interest, instead of waiting on collecting the interest over the years and collecting a lot of it, I may add. They want to get it quicker. So the way to get it quicker is just to get originating the loan, then selling it, getting some of the money back, getting all their money back plus some interest, some profit right away, and then just writing another loan. And that's what banks do in their end. Now, that is called the primary market, where loans are originated to the consumer, and where they sell those loans then to investors. This is termed the secondary market. So that's all it's to those terms. What is the primary market? It's where loans are originated to the consumer to buy real estate. And the secondary market is where those loans are then resold to investors. That's it. Now, primary market lenders, where you get money to buy real estate, would be mortgage bankers, brokers, and credit unions. Fannie Mae is the largest purchaser of loans in the secondary market. It's estimated that they own 1 out of every 10 loans that are out there they buy. So they have a lot of influence. So when your local bank is creating those lending guidelines, whether they're going to lend money to you or not, they like to make those guidelines match up with an investor who's likely to buy that loan, so that they know that if they originate it, they could pass it off and sell it to somebody right away. So Fannie Mae, being the largest purchaser of loans in the secondary market, they look at Fannie Mae's lending guidelines. If Fannie Mae says that they're willing to buy a loan with these certain criteria, your local bank will usually write their lending criteria to match Fannie Mae's, because they buy at 1 out of every 10 loans in existence. So they got a lot of pull. And more likely, if you write a loan that meets Fannie Mae's lending guidelines, even if Fannie Mae doesn't buy it, some other investor probably will. Now, Ginnie Mae, they share the same last name. Ginnie is Fannie's ugly stepsister. Now, why did I say she's ugly? Well, because she buys them risky loans, you know. So she's Fannie Mae's ugly stepsister. You know, she buys them risky loans from those with less than perfect credit, who may not be putting as much money down, and they make them more risky for the lenders. But with greater risk comes greater reward. They can charge higher interest rates, and those investors that fund these loans will then get paid back that money sooner and at a higher rate. But it's risky. And Freddie Mac, they buy conventional loans. Now, we know conventional loans are not written according to any third party's lending guidelines, because the lenders aren't planning on reselling those loans. But sometimes they need liquidity so that they could get involved in other investments. So they sell off some of their assets. Who's going to buy some of the loans that they've written when they didn't follow any third party's lending guidelines? Well, Freddie Mac would. Okay, but each one of these loans, as you can imagine, they need to be gone over on an individual basis. So the primary source of funding in the primary market are those savings and loan associations, the banks, commercial lenders, which are private investors of all sorts, including insurance companies, mortgage brokers, credit unions, pension and trust funds. When a consumer applies for credit I put together this slide for you. This is nowhere in the book, or you may see these disjointed terms all over the place. I put it in a storyline pretty much. The first step is you apply for a loan pre-qualification. In order to get the pre-qualification letter from a lender, you provide them with your credit score, your social security number so they could run your credit, and then they check your history, your credit history, to determine if what the risk is involved in lending to you, and you're paying back, your history of paying back loans. And then they examine your what you tell them, how much money you make, and what you tell them, how much in long-term expenses you have. All that's been unverified at this point, but based on what you told them, they'll issue a pre-qualification letter to you. Doesn't mean that you're going to get that loan for sure, but that's the starting point when applying for credit. Most consumers go out shopping for a home when they only have a pre-qualification letter. Loan pre-approval letter is something you should then aspire to. To get this, now all the information about your debt and your income needs to be verified by providing bank statements and pay stubs and tax returns to the lender, as well as your social security number. And then it goes to the bank's underwriter. That's somebody who examines all the documentation and weighs out risk to the lender. And they'll issue a loan pre-approval letter to you once you've verified all that information that you provided in the to get a pre-qualification letter, but you then provided evidence of that debt and income. Then you graduate to a pre-approval letter. So pre-approval letter is much better. You're now approved for the loan. You could definitely get that loan. Underwriting is that process where an underwriter, somebody who works for the lender, examines the risk, and they carefully investigate all the documentation, the paperwork, the pay stubs, tax returns, bank statements, and they determine whether they're going to grant the loan. So the lender examines all the buyer's information, all the income and their debt to income ratio, credit history, all that, to determine the risk to the lender. Then they examine information about the property that's being financed, like an appraisal, at minimum a wood destroying insect inspection report, and any city documentation if required, which it usually is, like a certificate of occupancy and fire inspection. And then they're going to determine if they're going to grant the loan or not. And if they do, then they're going to commit to doing so by issuing what we call a loan commitment letter. So a commitment letter is issued after the borrower completes the loan application, submits their financial info, which is all verified, and then there's a property appraisal done and a home inspection. If the underwriter decides to grant the loan, they do so in what's known as a commitment letter. Now they're committing to give that borrower the loan. So that's the process of how it happens. So through the process, so on page 284, we could just highlight through the process known as underwriting, the lender carefully investigates the application information, studying credit, you know, all the stuff I pretty much said on the previous slide in a clearer form, which then continues on page 285 there, as you can see.
Oh, it's down at the bottom. Self, hold up. Through the process. Share credit history. not again.
Just let me know when you guys got that.
I got that. Oh yeah, I got that.
Now, how does the lender determine your credit score? Well, when they run your credit, they run it with all 3 credit reporting agencies. They don't average it out or do any complicated math. They just pick whichever score's in the middle, and that's your score.
That's great.
Qualifying ratios, I explained, are what lenders use to determine the maximum monthly expense for housing a borrower could afford to pay. So an example of a qualifying ratio is your debt to income, DTI. It's used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay. So this is what I'm having you write over here in your book next to qualifying ratios. Got an example. See, it says here, the first 2 bullet points is what I had written over here. So you could read my chicken scratch just by writing, copying over these first 2 bullet points into your book. Got a qualifying ratio. An example of a qualifying ratio is DTI, debt to income ratio, used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay. It's not used by them to determine how much they're going to lend to you. It's used by them to determine how much you could afford to pay monthly. And then based on how much you could afford to pay monthly, they determine how much they'll lend you. You may be thinking tomato, tomato, what's the difference? But there is one. So they kind of reverse engineer what we did with the last chapter with the mortgage charts, trying to figure out what your monthly mortgage payment would be. They take your monthly mortgage payment to see what's a maximum monthly mortgage payment you could afford to make. And then based on that, they'll determine how much they will lend you. So let me know once again when you guys got that all down.
I got it. I'm just messed up. I need another marker.
Uh-oh, highlighter's running low.
Highlighter is running out. And I had highlighters down here, but I need one light enough. Let's see. Let's see if this will work. I still see text through this. Oh, that'll work. Let's try those.
Or you could try dipping the front end of your highlighter in water for a couple seconds, and then wait a few more seconds before you actually use
No, I
it.
got another one. I think this will work.
Wait, the word do I hope it for?
Yeah, that could
Yeah.
that could extend the life a little bit.
Temporarily.
I never knew that.
Mhm.
I think it's what's like
Yeah, I just looked up a video
a
on
little longer or something like that.
eHow
Gives you a little longer life.
on extending the life of a highlighter. Yeah, because sometimes they dry out, you know.
Yeah, I got another one. It's orange, but who cares? It might seep through. It will seep through.
Yeah, I bought a box of like 25 of them in a box, so better off getting deals of them on Amazon.
Oh, excuse me. So
Yeah, everybody got these notes down yet, or are you still writing?
yeah, I'm good. I'm good.
Yeah, I'm good.
Oh, okay. So the Fed, the Federal Reserve, you may have heard of it. It's actually not a part of the government at all. It's our version of a central bank, and every country has their own central banking system. So the Federal Reserve, the Fed, is not part of the government. It's basically a headquarters for all the banks that do business in the country. They're all a member of the Federal Reserve. Um, Now, to try to counter inflationary and deflationary trends, to help establish economic stability and maintain sound credit conditions, they alter the AFR, the applicable federal rate, which is what lending is based on. Remember, I told you there's a cost of money to lenders. So when the banks lend money, the Fed tells them what the baseline interest is, and then whatever amount they charge over that is what they'll make money on. Okay, so basically, the Fed, that group of bankers, they basically cover each other's butts anytime one of them is in danger of going under, because let's just say all their depositors all of a sudden lose trust in that bank and they rush to that bank to try to take out all their money. Um, that could bury a bank because they don't have the money. Have you guys ever went to the bank and tried to take out a large amount of cash without notifying them in advance? And they're
Yeah.
like flipping on you. They're like, "Oh, whoa! You got to reserve this. You got to let us know, give us a heads up, so we'll have the money here." I'm like, "What the hell? It's a bank. Shouldn't you have my money?" Well, no, banks don't usually carry large amounts of funds anymore. They don't even have vaults anymore. Banks used to get robbed all the time because they kept a lot of money in them. People, they usually don't keep a lot of money in banks anymore. Well, yes, partially because they get robbed, but also they don't have to worry about having a big vault, a whole room that's basically a safe, these big expensive safes, because they don't carry a lot of cash. So if you want to take out, a couple of grand of cash, they may not let you do it, unless you arrange with them in advance to come take out that money. Now, it is your money and you have the right to come take it out. But if everybody now wanted to pull out their money at the same time, it could bury that bank. So what will happen is all the other member savings banks will step in to try to cover the money that they're supposed to have of yours. But a lot of these banks, they invest that money. Uh, uh, they create loans by lending money to people to buy houses and cars and stuff. Now, I told you that they lend their depositors money, but I also told you that technically that's not right, because it's not. Technically, your bank is not lending anybody's money. Technically, They're just conjuring it up out of thin air. And if you watch this Money is Debt documentary video, it'll explain to you how that works. So even though the Federal Reserve System is not part of the federal government, it's the central bank created by Congress in 1913 to establish economic stability. It's setting rates, creating new money, and fractional lending. The AFR is the applicable federal rate. Now, there are presidents from way back when that they regretted when they went when they created the central banking system. Then they also regretted when they allowed us to go off of the gold standard much later years. It used to be that money it had to be backed by gold or silver, had to be backed by something precious metal. Now they just conjure it up like a magician with their magic hat and their wand, and they just conjure it up, and they pull the money out of thin air. It seems too simple to be true, but it is. Here, I'll show you guys a couple minutes of this video. Why not?
Hold up.
This is Money is Debt.
Wait a minute.
Oh no, hold up. What happened?
No, go ahead. I'll still doing the slide. Did you have this video in another slide too?
I had a link to it, and I sent you the copy of the link.
Okay. I was just making sure because I think I started it and it.
Yeah, it started playing this. Yeah, I sent you the link in the last chapter that I referenced it, but I didn't play any of it. So I'll play a couple minutes of it because it is interesting. But I'll just give you a teaser and play a couple minutes of this. Hopefully, you guys are getting it come across nice and clearly. So let me play that again. I'll mute myself and play this for you. By the way, when I mute myself, can you guys still hear this?
No. No.
All right, then I'll unmute myself. Yeah, so you got to hear it through my speakers then. The Rothschilds.
Two great mysteries dominate our lives, love and money. What is love is a question that has been endlessly explored in stories, songs, books, movies, and television. But the same cannot be said about the question, what is money? It's not surprising that monetary theory hasn't inspired any blockbuster movies, but it was not even mentioned at the schools most of us attended. For most of us, the question, where does money come from, brings to mind a picture of the mint printing bills and stamping coins. Money, most of us believe, is created by the government. It's true, but only to a point. Those metal...
Is the audio coming across clear to you guys?
Yeah.
Okay.
Not really. A little shaky.
Oh.
Are you understanding what he's saying? I mean, or is it coming through just a little bit muffled, or?
Yeah, just coming through muffled.
But you could make out what he's saying there. Let me
say it again?
let me do this. I'm going to hit this optimized for video button over here because let's see what this does. Hopefully this makes it a little bit clearer. Before, for some people, it put a little black mark across the screen, but let's see if it makes the audio clearer for you guys, the optimizing of this video as I play it. And we'll try it
Hold on a
again.
second.
Let me know if it comes across better.
And paper symbols of value we usually think of as money are indeed produced by an agency of the federal government called the Mint. But the vast majority of money is not created by the Mint. It is created in huge amounts every day by private corporations known as banks.
Is that coming across clearer?
Most of us believe that banks lend out money that has been entrusted to them by depositors. Easy to picture, but not the truth. In fact, banks create the money they loan, not from the bank's own earnings, not from the money deposited, but directly from the borrower's promise to repay.
Is that coming across clearer for you guys or no? Hello?
Yeah, it
I'm
is.
here.
Okay.
I'm here. I gotta do something outside.
Borrower's signature on the loan papers is an obligation to pay the bank the amount of the loan plus interest,
Oh, that's
or
clear.
lose the house, the car, whatever asset was pledged as collateral. That's a big commitment from the borrower. What does the same signature require of the bank? The bank gets to conjure into existence the amount of the loan and just write it into the borrower's account. Sound far-fetched? Surely that can't be true. But it is. To demonstrate how this miracle of modern banking came about, consider this simple story, the goldsmith's tale. Once upon various times, pretty much anything was used as money. It just had to be portable, and enough people had to have faith that it could later be exchanged for things of real value, like food, clothing, and shelter. Shells, cocoa beans, pretty stones, even feathers have been used as money. Gold and silver were attractive, soft, and easy to work with, so some cultures became expert with these metals. Goldsmiths made trade much easier by casting coins, standardized units of these metals whose weight and purity was certified. Well, to protect his gold, the goldsmith needed a vault, and soon his fellow townsmen were knocking on his door, wanting to rent space to safeguard their own coins and valuables. Before long, the goldsmith was renting every shelf in the vault and earning a small income from his vault rental business. Years went by, and the goldsmith made an astute observation. Depositors rarely came in to remove their actual physical gold, and they never all came in at once. That was because the claim checks the goldsmith had written as receipts for the gold were being traded in the marketplace as if they were the gold itself. This paper money was far more convenient than heavy coins, and amounts could simply be written instead of laboriously counted one by one for each transaction. Meanwhile, the goldsmith had another business. He lent out his gold, charging interest. Well, as convenient claim check money came into acceptance, borrowers began asking for their loans in the form of these claim checks instead of the actual metal. As industry expanded, more and more people asked the goldsmith for loans. This gave the goldsmith an even better idea. He knew that very few of his depositors ever removed their actual gold, so the goldsmith figured he could easily get away with lending out claim checks against his depositors' gold, in addition to his own. As long as the loans were repaid, his depositors would be none the wiser and no worse off. And the goldsmith, now more banker than artisan, would make a far greater profit than he could by lending only his own gold. For years, the goldsmith secretly enjoyed a good income from the interest earned on everybody else's deposits. Now a prominent lender, he grew steadily richer than his fellow townsmen, and he flaunted it. Suspicions grew that he was spending his depositors' money. His depositors got together and threatened withdrawal of their gold if the goldsmith didn't come clean about his newfound wealth. Contrary to what one might expect, this did not turn out to be a disaster for the goldsmith. Despite the duplicity inherent in his scheme, his idea did work. The depositors had not lost anything. Their gold was all safe in the goldsmith's vault. Well, rather than taking back their gold, the depositors demanded that the goldsmith, now their banker, cut them in by paying them a share of the interest. And that was the beginning of banking. The banker paid a low interest rate on deposits of other people's money that he then loaned out at a higher interest. The difference covered the bank's cost of operation and its profit. The logic of this system was simple, and it seemed like a reasonable way to satisfy the demand for credit. However, this is not the way banking works today. Our goldsmith banker was not content with the income remaining after sharing the interest earnings with his depositors, and the demand for credit was growing fast as Europeans spread out across the world. But his loans were limited by the amount of gold his depositors had in his vault. That's when he got an even bolder idea. Since no one but himself knew what was actually in his vaults, he could lend out claim checks on gold that wasn't even there. As long as all the claim check holders didn't come to the vault at the same time and demand real gold, how would anyone find out? This new scheme worked very well, and the banker became enormously wealthy on the interest paid on gold that did not exist. The idea that the banker would just create money out of nothing was too outrageous to believe, so for a long time the thought did not occur to people. But the power to just invent money went to the banker's head, as you can well imagine. In time, the magnitude of the banker's loans and his ostentatious wealth did trigger suspicions once again. Some borrowers started to demand real gold instead of paper representations. Rumors spread. Suddenly, several wealthy depositors showed up to remove their gold. The game was up. A sea of claim check holders flooded the street outside the closed doors of the bank. Alas, the banker did not have enough gold and silver to redeem all the paper he had put into their hands. This is called a run on the bank, and it is what every banker dreads. This phenomenon of a run on the bank ruined individual banks and, not surprisingly, damaged public confidence in all bankers.
It also happened recently. What was that California? They had that bank. What's that? Silicon Valley Bank, and then in New York City, there was a bank in New York, a long-standing bank that recently went under as well. The feds took it over. Took both these banks over when incredibly they were not insured by the federal government, which was curious. A lot of people are saying that the government stepped in and covered these banks and saved them, though, because of their political ties and because they were donating a lot of money to a certain political party. So they stepped in there and they were they backed them until they could be solvent, and they were then sold and eaten up by, I believe it was Chase or Citi, one of those. I think it was Chase. Yeah, J.P. Morgan. So this is a run on the bank. I'm going to play just a couple minutes longer so that you could see how lending works today, how they come up with this, and how they got around this problem of runs on the banks.
It would have been straightforward to outlaw the practice of creating money from nothing. But the large volumes of credit the bankers were offering had become essential to the success of European commercial expansion.
Too big to fail.
So instead, the practice was legalized and regulated. Bankers agreed to abide by limits on the amount of fictional loan money that could be lent out. The limit would still be a number much larger than the actual value of gold and silver in the vault. Quite often the ratio was 9 fictional dollars to 1 actual dollar in gold. These regulations were enforced by surprise inspections. It was also arranged that, in the event of a run, central banks would support local banks with emergency infusions of gold. Only if there were runs on a lot of banks simultaneously would the banker's credit bubble burst and the system come crashing down. Over the years, the fractional reserve system and its integrated network of banks backed by a central bank has become the dominant money system of the world. At the same time, the fraction of gold backing the debt money has steadily shrunk to nothing. The basic nature of money has changed. In the past, a paper dollar was actually a receipt that could be redeemed for a fixed weight of gold or silver. In the present, a paper or digital dollar can only be redeemed for another paper or digital dollar. In the past, privately created bank credit existed only in the form of private banknotes, which people had the choice to refuse, just as we have the choice to refuse someone's private check today. In the present, privately created bank credit is legally convertible to government-issued fiat currency, the dollars, loonies, and pounds we habitually think of as money. Fiat currency is money created by government fiat or decree, and legal tender laws declare that citizens must accept this fiat money as payment for debt, or else the courts will not enforce the obligation. So now the question is, if governments and banks can both just create money, then how much money exists? In the past, the total amount of money in existence was limited to the actual physical quantities of whatever commodity was in use as money. For example, in order for new gold or silver money to be created, more gold or silver had to be found and dug out of the ground. In the present, money is literally created as debt. New money is created whenever anyone takes a loan from the bank. As a result, the total amount of money that can be created has only one real limit.
By the way, if you ever look up that term, money as debt, you can see the books from Robert Kiyosaki were based on that, where he tells you that value, where money comes out of debt, and there's such things as good debt. Good debt is basically debt that you can write off against your taxes. But you look up Robert Kiyosaki. He's got the book Money as Debt. You have what the hell is it? Robert Kiyosaki has Money as Debt. Donald Trump has the thing about negotiations. I forget what his book is called. There's several of these millionaires that got rich in real estate that they actually tell you what to do and how to do it, and they give you good strategies. So a lot of people who invest in real estate are familiar with these types of books.
The total level of debt. Governments place an additional statutory limit on the creation of new money by enforcing rules known as fractional reserve requirements. Essentially arbitrary, fractional reserve requirements vary from country to country and from time to time. In the past, it was common to require banks to have at least $1 worth of real gold in the vault to back $10 worth of debt money created. Today, reserve requirement ratios no longer apply to the ratio of new money to gold on deposit, but merely to the ratio of new debt money to existing debt money on deposit in the bank. Today, a bank's reserves consists of three things: the amount of government-issued cash that the bank has in its vault, the amount of credit it has with the central bank, and the amount of already existing debt money the bank has on deposit. To illustrate this in a simple way, let's imagine that a new bank has just started up and has no depositors yet. Investors have paid for the bank's infrastructure and have supplied it with sufficient cash to meet the demand for cash withdrawals. Typically, cash in the vault will amount to no more than $1 for every $20 or $30 that could be demanded from the bank. The bank has joined the central bank system, which permits the new bank to borrow cash from the central bank if it's needed. The doors open and the new bank welcomes its first loan customer. The customer needs $10,000 to buy a car. On approval, the bank creates an account for the borrower and types in that the bank owes the borrower $10,000. This $10,000 is not taken from anywhere. It's created on the spot. The borrower does not take this money out in cash. Instead, he writes a check on his account to buy the car. The seller then deposits this newly created $10,000 check at her bank. At a ratio of 9-to-1, this new $10,000 deposit allows the seller's bank to create a new loan of $9,000. And if that $9,000 is then deposited by a third party, it becomes the legal basis for a third issue of bank credit, this time for the amount of $8,100. Like one of those Russian dolls, each layer of which contains a smaller doll inside, each new deposit contains the potential for a slightly smaller loan in a decreasing series. Now, at any stage, if the money created is taken out in cash and not deposited at a bank, the process stops. That's the unpredictable part of the money creation mechanism.
And probably why the government will then send the Treasury after you to seize your funds. You know, they don't want you hoarding cash in your house or driving around with it. Just try driving around one of the border states with $10,000 or more cash in your car. The government will seize it. Cops will pull you over. They'll seize it. They'll contact somebody from the Treasury Department. The Treasury Department comes and they take that cash until you could prove that you got it legitimately through legitimate means. Otherwise, they keep it. And then they share it with the law enforcement agency.
But more likely, at every step, the new bank credit money will be deposited at a bank, and the reserve ratio process can repeat itself over and over until almost $100,000 of brand new bank credit money has been created within the banking system. All of this new money has been created entirely from debt, and all transactions have been carried out with bank credit. None of the banks involved have needed to use any of the cash in their vaults. What's more, under this ingenious system, the books of each bank in the chain must show that the bank has 10% more on deposit than it has out on loan. This gives banks a very real incentive to seek deposits in order to be able to make loans, supporting the general but misleading impression that loans come out of deposits. Now, it can't be.
Okay, we'll leave it right there. This is a long video. We've watched 16 minutes of it already. I don't want to watch the whole video. I mean, I do. It's an interesting video, but I don't want to waste your guys' time watching this whole entire video. So I'll give you the link to it here again. It is an interesting video. It's called Money as Debt. And we do have it on our Facebook page as well. But here's that link to it. Money as Debt. It's pretty interesting, huh? At least I think so. I don't know.
Yeah, definitely. Yeah, no, it is. I think it is. You got to understand where the money is.
And I mean, the guy does an ingenious way of explaining it. I mean, even though this is a fictional story that he's coming up with the goldsmith and stuff, it's a very good representation of how the monetary system actually works and how it came about over time, even though it wasn't this particular goldsmith, you know. But he's representative of a whole bunch of people, you know, the goldsmith, the Rothschilds, and what's that guy, J.P. Morgan, you know, he was big at
percenters.
Yeah, all them 1%ers, right? When the men who made America, the titans of industry, watch. Right. That's that other series of shows I told you guys to watch, right? That'll explain about all of that, everything about from the railroad to gas to electricity to automobiles to steel to the banking industry, you know, and these wealthy families, how they became so wealthy. It's really interesting. Then again, I'm a buff of history and stuff like this, so I like to learn about it. Okay, so anyway, that's how the Federal Reserve. That's what the Federal Reserve is. It's our central banking. It's our central bank. Okay, so now you guys have a better idea of what a central bank is, and it's not actually a part of the government, although the government does work closely with central banks. Okay, so lenders who supply funds to borrowers that's called the primary market. And then when those loans are originated in the primary market are sold to investors, that's deemed the secondary market. Okay, so government does have a lot of influence in lending through the Fannie Mae. Fannie Mae buys 1 out of every 10 loans that are in existence. Fannie Mae has a lot of say in the lending standards of a lot of banks.
Quick question, Victor. Is there
Yeah.
something underneath Fannie Mac on your slide?
Oh yeah,
Is
hold
that-
on one second. Let me
That thing
remove
is
that.
there again.
Yeah, there we go. Better?
Oh, there you go. Okay.
Okay. That's that optimized for video thing. Okay, so Fannie Mae, or their stock symbol FNMA, which comes from their old name, Federal National Mortgage Association, operates under a shareholder-owned company under congressional charter. In the past, that description used to be a lot different. It's under a congressional charter because it's monitored by Congress now, because all them major bailouts of too big to fail, all these banks that were losing out, they were bailed out by the government. So it's now Congress. It used to be a privately owned company. Now it's a shareholder-owned company, operating under congressional charter. That means Congress. So it's the largest purchaser of loans in the secondary market. They buy 1 out of every 10 loans in existence. And when they change their criteria for the types of loans they're willing to buy, guess what your local banks do? They change them to match. They call these conforming loans. They conform to Fannie Mae's lending guidelines for the types of loans they're willing to buy. Now, don't confuse this with conventional loans that you get from portfolio lenders, because they have no influence by any third party's lending guidelines, because they're lending their own money and making the decision on who they're going to lend to. Ginnie Mae, Fannie's ugly stepsister, well, she buys loans in the secondary market too, but those riskier loans. And her stock symbol is GNMA, Government National Mortgage Association. You can even sound these out, like Fannie Mae's. Sound that out. Fannie Mae, right? Fannie Mae. Fannie Mae. Ginnie Mae. Ginnie Mae. Or you could just look at their last names, because on state exams, sometimes they got a stupid question, and I don't understand the significance of it. They give you a bunch of lists of these different lenders and investors, and they say which ones are related. I guess they got the same last name, Fannie Mae and Ginnie Mae. But don't listen to Sally Mae, because she's the one that gives loans for schools, for education. Now, Freddie Mac, or FHLMC, that's formerly called the Federal Home Loan Mortgage Corporation. They purchased those conventional loans from portfolio lenders. All right, so let's highlight under Fannie Mae on page 286. Loans that meet Fannie Mae's guidelines are called conforming loans. They conform to Fannie Mae's lending standards, lending guidelines. I know.
Ginnie Mae.
And then Ginny, that's Fannie's ugly stepsister. Either way, just know they're related. I try to say that little story over and over again so that you guys can keep the relation in mind,
That's messed up. Okay.
And then we have non-conforming loans. Those are loans that do not meet Fannie Mae's lending guidelines. If those loans that meet Fannie Mae's lending guidelines, they conform to their lending guidelines, are called conforming loans. Then those that do not meet Fannie Mae's lending guidelines for the loans they're willing to purchase, those are called non-conforming loans. Okay, So we don't get loans from, let's see, we do, well, who do we get loans from that are not conforming to Fannie Mae's lending guidelines? Well, you get them from portfolio lenders who don't care about any third parties' lending guidelines. Okay. They're more flexible in their lending because they're the ones that make the final decision on who they're going to lend their own money to. Make sense? So those are portfolio loans or conventional loans that come from portfolio lenders. Borrowers with unusual credit situations, not bad credit, or buying unique houses or large construction projects, you would get these loans from those portfolio lenders that are non-conforming to Fannie Mae's guidelines. Fannie Mae may have loan limits on how much they'll lend to buy a house, just like the FHA does, you know. And ones that are larger than Fannie Mae's lending loan limits, those are jumbo in size, so they call them jumbo loans that are non-conforming. Yes, that is a real term, jumbo loan, and often you'll get it on exam. What do we call loans larger than Fannie Mae's lending limits for those that they're willing to buy? Jumbo. I know some students don't select jumbo because they're like, oh, that can't be it. That's too obvious. You know, it's got to be fake. No, that's real. Jumbo. It's jumbo. Jumbo. It's big, really big. Jumbo. All right. So, Freddie Mac, they buy primarily those conventional loans, the ones that were not written according to some third party's lending guidelines because they were planning on keeping them within their own investment portfolio the whole time. But sometimes they need to liquidate their assets so they could invest in something else. So they'll try to sell them off. And who's going to buy them? Freddie Mac. So let's highlight on page 287 there. Loans higher than the secondary market limit are known as jumbo loans. They're non-conforming. And the borrower who wants to place one would search for local lending institutions that are making portfolio loans. Okay.
Non-conforming. Oh, wait a minute. I missed something. Primarily. Freddie Mac mortgages.
All right, you got that?
No, 1 second.
No. Okay.
I'm almost done. I'm almost done now. Oh shoot, this new highlighter is giving me. It's giving me issue. Okay. Federally mortgage. Okay.
Okay. So let's just copy these notes down, then we'll move on to the next slide that'll talk about this stuff a little more. You know, purchase money mortgages, those are any loans used to buy real estate. Well, reverse mortgages, those are loans for seniors. It pays back the equity to them that's been built up over time, which I recently seen a new reverse mortgage commercial on TV, and I got to get that one. That one actually gets into it a little bit better. And then we have the home equity loans. It's type of second mortgage. And bridge loans, swing loans, interim financing. So go over those, highlight those, make those notes. Let me know when you got it.
was doing good shit. A second. And this is called the bridge loan. Okay.
All right. Right.
I'm almost done. I'm almost done.
Okay.
All right, I'm done.
All right. So purchase money mortgage, read it backwards. It's mortgage money to purchase. It's any loan used to buy real estate. Seller financing is also considered to be a purchase money mortgage because you're getting money. It's just instead of getting it from some other lender, the seller's providing the financing. So it's any loan used to buy real estate would be classified as a purchase money mortgage. Reverse mortgages are specific loans for senior citizens that are 62 and older. It allows them to tap into the equity built into their homes. It's based on the equity that they built up over time when they've paid off that loan. So it's usually required that they had to have the majority of the loan paid off, at least 60 to 70% of that loan paid off. It's a first mortgage, not a second. If there's any balance on the remaining loan, when you get a reverse mortgage, it'll pay off that balance. And now, instead of the borrower, the mortgagor, making monthly payments to the mortgagee, the lender is actually making monthly payments to the borrower. It's the opposite. It's the reverse of what's normal. And the best part is the senior does not have to pay back the loan until they sell the home or die. But they do need to maintain it. They do need to pay private mortgage insurance on that loan as well. They got to pay the taxes on the property still. But this is a way to subsidize their income. These are expenses they would have had anyway. This is a great way for the senior to live out their golden years in dignity. Especially if they don't have a nest egg saved up, or they're not getting some government pension that's paying them a percentage of their normal salary. Most people don't get that. Maybe a government worker would, or maybe some of the old folks that may have worked for companies, the big companies that offered those types of retirement plans that you really don't see offered anymore. So in order to live out your golden years, if you didn't save up money for your retirement plan, Social Security ain't a whole lot to live on, even though it's paying a lot more these days. We're always hearing about how it's going bankrupt, and they increase how much it's paying out. But what do politicians care? They just want the vote from the seniors again. They know it's going to be a problem, and they keep using that as an issue. That's why they don't want to fix it. It's an unfunded liability, which that's kind of a hot button term, because the people who are getting paid that money back, they paid into this retirement system during their whole lives as they worked. But when it gets paid out back to them, it pays back way more than it ever took from them. So it's and especially right now where we have illegal aliens coming in, and some of them are even able to apply for and get these Social Security benefits, which is insane because they never paid into the system. So allowing that is a slap in the face to seniors, or to anybody who's not yet a senior that's been paying in, and they're lying to you about how the Social Security is in danger, and they always use it as a political issue. But hell, if they could send money over to the Ukraine in the billions, I'm sure that they could add some money to this system, right, and let that problem go away. But they don't. It's always an issue. Anyway, to find out more about reverse mortgages, you could go to reversemortgage.com, or I found this latest video. Let's take a look. I just looked it up really quick. Let's see if we could play it. Is this the latest video that I seen? I'm not sure. I looked up 2023. Yeah. Let's see if this is the one.
It's payback time. All these years you've worked hard, you fixed it, you looked after it. Maybe it's time for your home to start taking care of you.
We've invested in our home, we've worked on it.
We had a whole lot of equity just sitting there.
You paid down the mortgage, invested in your home. I guess you could say your home owes you.
If you're 62 or older and own your home, learn how you can access a portion of your home equity to give you cash. A reverse mortgage can put more money in your pocket by eliminating your monthly mortgage payments, paying off higher interest credit cards, and covering medical costs.
Look, AAG can show you how a reverse mortgage loan uses your built-up home equity to give you tax-free cash for almost anything you might need.
Just eliminating the mortgage payment freed up a lot of cash for us.
I get to go and do what I want when I want.
AAG customers talked about the counseling they got along the way, so they know how a reverse mortgage works and how their home could help pay them back when they need it the most.
I have no worries anymore.
The fact that we're still in this home means so much.
It's done everything for us that we hoped it would do for us.
Call now to receive your free no-obligation info kit. The kit shows you how to get you the cash you need using your home's equity with a reverse mortgage. Find out how your home can start taking care of you. Call 800-721-5456.
The worry every single month to make that payment was gone.
Our customers' homes are taking care of them. Maybe your home could do the same for you.
Call AAG, the country's #1 reverse mortgage lender, and get your free info kit. Call 800-721-5456. That's 800-721-5456.
All right, so this reverse mortgage, you get some people, they talk negative about reverse mortgages, but when I was a kid and I was growing up, I remember commercials on TV. It wasn't commercials, it was actually the news, where newscasters were sticking microphones in some senior's face and saying, well, how do you survive? How do you live? How do you get by on the meager amount of money you're getting on Social Security? And they're like, well, it's a struggle being on a fixed income. We don't have a lot of savings. And sometimes we have to decide, are we going to buy food or are we going to buy the medication that we need to keep us alive? And it's a struggle. And then they show you they're petting their cat, Fluffy or whatever, and they're opening up cat food for the cat. And they go on to say how if it's nutritious enough to feed the cat, you know, so therefore the seniors were eating cat food, you know, to survive. That's not living in dignity, you know. So I guess at the presidential level, they seen that, and so President Reagan passed a law that allowed lenders to pay back, to create this reverse mortgage program that would allow the because you can't wait on Congress. It's been that long, and Congress never came up with a solution still to this day. So, you know, he came up with this idea that allowed the lenders to be able to offer these reverse mortgages to the seniors so that they can have additional funds to pay their bills. Now, since back then we also didn't have these subsidized drug programs for seniors and poor people. Now you guys are getting gift cards or getting these cards in the mail, and you're not even applying for them, right? You're getting these discount drug programs in the mail, right? Those cards. You guys know what I'm talking about? You guys get those in the mail at all? You know, people get these things all the time for you get discounted drugs or even free for seniors and poor people. You know, they could qualify for these things. But look, everybody gets these. I mean, I get them. I'm not a senior, and I get these drug cards in the mail that show you how you get them at a discounted rate. You know, without even having insurance, they give you these plans. But that didn't exist back then. That was all thanks to Montel Williams, who was a talk show host back in the day. A Marine motivated guy, you know, self-sufficient. You know, he had a show on TV. It was a talk show, the Montel Williams Show. And he started negotiating with these drug companies. He saw the need for that as well. And he knew our politicians weren't doing anything about it. So he used his fame and to throw around his weight a little bit and negotiate with these drug companies to offer free or discounted drug programs for poor people and seniors who couldn't afford them, you know. You know, today it's a popular thing. You see them all over the place. Let's see. Then we have these reverse mortgages that which are great today because they don't offer these retirement plans to people like they used to. And even those that did back in the day that had them, there was a lot of people that didn't, you know. So, but people had homes, and if you had homes, you could now pull out that equity that you've been paying and building up over the years, use that for living out your senior golden years in dignity. All right, so that's what a reverse mortgage is. Now, some people would complain, oh yeah, but then if I'm somebody's kid, oh, I can't, so who's going to get the house? The bank's going to get the house at the end of the day? No, you could pay back the bank all the money that they paid to your parent. If you want that parent's house, wanted them to leave it, if they were going to leave it to you, you could pay back the money that they drew out that they needed to survive because you weren't helping them out, so they had to resort to this. Sure, you could pay back the bank and then get that house. Or the bank gets the house, they sell it, they get back their money plus the money that they paid out, plus any profit that they needed to make off of it. But that profit is capped at $6,000, so it's not like they're stealing the value of the home. And the private mortgage insurance that the borrower had to pay for. But other than that, all the equity goes to the heirs, you know, or back to the senior when they sell the house or die. So I got a couple slides here about those commercials, all kinds of commercials like that. I'm going to skip them all because that last commercial that I just looked up, the most recent one, covered the details on it. So under a shared equity mortgage, the purchaser receives some financial help in the form of a contribution towards the down payment, concessionary interest rate, and assistance with monthly payments. The partner may receive, may be a lending institution, the seller, the government, or a relative. Typically, the partner receives a share of the profit when the property is sold, or they could be a religious organization. What is a shared equity mortgage? You know, remember I told you sometimes in some religions, people say it's against their religion to pay interest. Well, a shared equity mortgage, you don't get charged interest. Okay. Instead, the person who's lending you the money becomes a partner, a co-owner with you in your house that you buy. You get a loan from them. You have to pay that back, that loan at 0% interest. But when you eventually sell that property at a profit, that partner receives a share of the profit. You're splitting the profit with them. Sounds fair considering you're not paying interest on the loan. It's called a shared equity loan, shared equity mortgage. And that's on page 287 at the bottom. And then continuing on the next page, we have the package mortgage, covers not only the real estate, but all fixtures and appliances on the premises. It's a package deal. It's a loan to buy real estate and chattel. This is often used by like new condos that are fully furnished or that may come with all the appliances, you know, the appliances that would normally be personal property, chattel, you know, that tangible personal property. A blanket mortgage covers more than one parcel or lot and is used to finance subdivision developments. These mortgages often include what's known as a partial release clause that would not require the borrower to pay back the entire loan at that time, but in segments, as you pay back, as you sell off smaller lots off of the larger one, you only pay back part of the loan. Okay, that's called a partial release clause. Instead of having the alienation clause that requires the entire loan be paid back when you sell a property or transfer the ownership. And then we have a wraparound mortgage. Wraparound mortgage is a seller who collects payments on the new loan, usually at a higher interest rate, and continues to make payments on the old loan. So what is that? A wraparound mortgage is, say that I have a house and I have a loan on that house that is assumable. That means that I don't need to pay it off when I sell it as long as I continue making payments on it. So as a homeowner, I could make payments on my loan. I could keep my existing loan on my property, and then I could write and give you seller financing, maybe at a 1% interest rate higher. This is that new loan that I give you. It does not disturb the underlying financing. It wraps around it, never disturbing it, okay? But people who get these types of loans, they should always make sure they have an agreement signed with that seller that they'll be able to communicate directly with their lender in the event they stop making payments to the lender, so that they don't lose their interest and equity in the property, that they could continue doing that. So you'd have an attorney definitely involved in making these custom contracts for this stuff, for a wraparound mortgage. So the existing loan does not have to be, does not have an alienation clause in it, because an alienation clause would prevent a loan from being assumable and would prevent the lender from being able to offer such seller financing like this on a property they already have a loan on, perhaps. Okay, everybody got those highlights?
Oh.
Did you say no?
Yeah, I'm good.
Oh yeah, wait, I didn't see the existing loan doesn't alienate clause wrap around.
Doesn't have an alienation clause.
Yes. Okay, got it.
And the open-ended mortgages, they never really close. The borrower can then draw on them if the lender agrees to allow it, and use it as a credit card every time they build up equity. You know, that's an open-end mortgage, but I don't think you're getting that one on exam, so I'm just going to skip that one. Even though I just explained it, but okay, so home equity loan is a type of second loan, but unlike that reverse mortgage, the borrower has to start paying it back right away. Sometimes they could get a home equity line of credit. That's kind of like a credit card to draw on that that equity as it's as you like. you're pre-approved for an amount of equity, and they give you a credit card, so you don't got to pull it out all at once. You can use it little by little, and as you use it, you got to pay it back too. That's a type of second loan, the home equity line of credit. Then we have a bridge loan. This is a short-term financing. Bridge loans are interest-only loans. Let's go to the next slide for a second, which will explain those bridge loans a little bit. So usually when a seller is buying a new home, before they sell their existing one, we try to do coinciding closings within the same month. So the owner doesn't have to make payments on 2 mortgage loans at once, because most people can't afford to do that, right? So when this is not possible to do, a bridge loan is a good option. So you get one loan that'll help you swing the payment on 2 loans at once instead of having to make payments on multiple mortgage loans. Now, this is meant for short-term periods. It's an interest-only loan meant for no more than 6 months. Usually when a homeowner buys one home before they sell on their existing one, it allows them to bridge the gap so that they can swing the payment in the interim. That's where they get that terminology: bridge loan, swing loan, interim financing. It's used when the seller buyer can't afford making payments on 2 mortgages, which most people can't. So the shared equity loan, I already went over. That's where you get that investor that loans you the money at a 0% interest. It's an interest-free loan. You've got to pay back that loan in installments. But when you eventually sell off that house, any equity that may have been built up in it or over time, that when you sell off that property, the investor will share in the profits of the sale of that property. They become a partner co-owner. And then you have a package mortgage, a loan used to finance the purchase of real estate and chattel. It's a package deal. Blanket mortgage covers more than one parcel, often used to finance small subdivision developments. It has a partial release clause in it that as you divvy up a lot into smaller lots and you sell those smaller lots off of the larger one, you don't have to pay back the entire loan at one time. Like most loans have an alienation clause in them that says that when you sell the property, that the entire loan needs to be paid back. That's also known as the due on sale clause in the note. The partial release clause is like a modified alienation clause that allows you only to pay back to sell off smaller lots off of the larger one and only pay off a portion of them as the smaller lots are paid off. So here's an example. So you have one big lot you bought, and now as you sell off, you subdivide it, you sell off smaller lots off the larger, then you only pay back a portion of that loan as those lots are sold back or sold off. Make sense?
Yeah.
Okay.
I think.
And once again, I already explained to you the wraparound mortgage. It's when you have you don't have an alienation clause. Your loan is assumable. You could sell your property without paying off the loan and then offer seller financing to a new buyer. The existing financing that you have as the property owner does not affect the new financing that you're offering to the new buyer. It wraps around it. So one financing has nothing to do with the other. Does not affect the underlying financing. And those open-ended mortgages, they never close out on the loan, and you could draw on it like a credit card if the lender allows it. Construction loan is a first loan, not a second. To construct means to make new. We're not talking about building something or the rehab loans where you're putting additions on houses or fixing them up. I mean, those are considered construction loans as well. And even in this paragraph, it probably even talks about that. But I want you to ignore that for exam purposes. When they talk about construction loans, they talk about the ones that are considered to be first loans and not second loans on a house. Okay? That would be a home improvement loan or a rehabilitation loan. Okay. The construction is to construct, to make new where there isn't anything. Okay. So right next to construction loan, a first loan, not a second. So that you get it right on exams anyway. Under a construction loan, the lender disperses the loan proceeds while the building is being constructed. They do so in phases. So usually you need a contractor to pay for and get the materials up front and to provide the labor up front, which then when they complete that work in phases, the lender will pay out money to the contractor, reimbursing them for their expenses for the materials and labor. And then they can move on and start the next phase of the construction. So this would prevent most small builders from being able to do this unless they have accounts with suppliers, you know, Lowe's, Home Depot. They usually have these contractors accounts with some of the smaller builders that supply the materials to them that they don't have to pay for up front if they know the person's getting a type of loan and they're qualified for the loan that is going to reimburse for these expenses and phases of the construction as they get done. Now those are all the types of loans. Now we're going to just talk about seller-buyer type of arrangements. Sale leaseback. What does that sound like? Well, you're selling a property and then you're leasing it back. This is common in commercial real estate. Instead of going out taking another loan so that you could buy and upgrade your machinery or equipment or expand your advertising and marketing or get another location or anything, you could instead just sell the property your commercial property that you may have a lot of equity in. Because you're the one who gets to decide who you're going to sell the property to, you first negotiate a favorable agreement to lease it back for a long period of time at an affordable price. All right, that's got to be equitable for both parties in the transaction, of course. So sale leaseback is sometimes used as a means of seller financing. The buyer becomes the lessor and the original owner becomes the lessee, some terminology that they use on exam, hint, hint. So a type of seller-buyer arrangement where the buyer becomes the lessor and the original owner becomes the lessee. Sale leaseback. Got that?
No.
No. Get it.
No.
Get it.
I'm getting it right now. Okay. This are the. All right, I'm good.
All right, so your typical seller financing works just like the financing with the bank. You know, when you purchase the property, you're given the buyer's given the deed, and then you make monthly installment payments to your lender, right? That's your typical seller financing arrangement. But there's another type of seller financing we call a land contract, if you recall from chapter 11 and then to chapter 12. A land contract is a type of seller financing where the buyer makes payments to the seller in installments and they wait for the deed. The owner does not give the deed right away to the buyer. They don't give that to the buyer until they've paid off the full amount owed or some other amount that they agreed upon. Ooh, I see we're well over to lunchtime, so after we're done with this slide, we'll take our lunch break. Okay, so the buyer makes payments in installments and waits for the deed. But in the meantime, they do have a financial interest in the property. That interest is called equitable title. Title meaning ownership. Equity is the difference, is your built-in value, the difference between the market value is and what's owed on the property. So even though you don't own the property yet, you do have a financial interest in the ownership. That ownership interest called equitable title. So if you were to start defaulting on making your payments to the seller in this lease to own type arrangement, it's easier for the owner to get you out than having to foreclose on you, but harder to get you out than a typical renter because you have a financial interest towards the ownership of it. And a lease option is a type of agreement where you're leasing the property and you have an option to buy it at a pre-agreed upon purchase price by a pre-agreed upon deadline in the future. These are contracts. Remember, any option contracts need to be prepared by attorneys. We can't prepare them. A lease purchase contract, on the other hand, is a bilateral agreement where you're going to lease a property and you're definitely going to purchase it at some predetermined deadline at a pre-agreed upon purchase price. That's called a lease purchase. All right, and then we'll leave off right there. We'll move over here, I guess, to the next one where you could, you don't really need to highlight all these. Maybe this one, land contract, also known as a contract for deed or installment sales contract. It's a type of seller financing. We went over it in chapter 11, page 217. Let me just check the next slide really quick. See that's on page 288 at the bottom.
Land contract 217. That's
bottom of the page.
Oh, that's down at that's right here. Several. What was at the bottom of the page?
What's on the top of this slide is on the bottom of the page. 288.
288. Oh, okay. Wait.
All right, we'll continue on now then. Chapter 15 here. Regulation Z. The Truth in Lending Act is implemented by Regulation Z, which does not apply to cash transactions, businesses, or commercial loans. Regulation Z requires that borrowers be fully informed of all the finance charges when getting financing. The rules do not apply to home equity lines of credit, reverse mortgages, or loans for movable dwellings. It requires full disclosure and truth in advertising when talking about financing in an ad. And Regulation Z requires that there must be at least 7 business days between the delivery of the loan estimate and the closing. Remember, the loan estimate is an estimate of the loan costs, which needs to be given to the consumer within 3 days of their completed loan application, or aliens, when they provided all the information that TRID requires. That requires delivery of early disclosures about proposed loan within 3 business days of that completed loan application. When is the loan application considered complete? Well, when the consumer provides the alien stands for address of the property, loan amount requested, income, estimated property value, names of the borrowers, and their social security numbers. When all that information is provided, then they need to put that loan estimate in the mail along with that the booklet for shopping for loans. And then there must be at least 7 business days between the delivery of the loan estimate and the closing. Did you get all the highlights in the? You may already have these from an earlier chapter. You skipped forward.
Yeah, I have these highlighted already.
Okay. So Regulation Z implements the Truth in Lending Act. It requires lenders to inform consumers of the true cost of obtaining credit. It allows consumers to compare loan costs, shopping from various lenders, And it requires full disclosure and truth in advertising if certain triggering terms are used in the advertisements. Okay, this does not apply to business or commercial loans. Like I said, it applies to all kinds of consumer financing, though, not just for real estate. Now, we as real estate agents, there's no reason for us to talk about financing in an ad since we don't offer financing. But if you want to get creative and tell people get in this house for monthly mortgage payments as low as whatever, well, now you're talking about financing, so you need to comply with the law as well. Regulation Z requires the disclosure of the APR, the annual percentage rate. That's the true cost of borrowing money. That's the interest rate that's advertised, plus any one-time non-reoccurring incidental costs associated with getting the loan. If you were to factor all those one-time fees that are not reoccurring into the life of the loan, it would affect the interest rate. It would bring it up just a smidgen higher, though. And if you were to factor that in and into the life of the loan, and then on the annual basis, how much would that raise the interest rate by? That's what an APR is. It stands for annual percentage rate. It's the annual percentage rate, the interest rate, plus including any additional loan costs, like loan application fees, appraisal fees, these fees that are not reoccurring, but are costs associated with getting the loan. It shows the consumer the true cost of borrowing the money. And the creditors that have to follow this law is anybody that extends credit 25 times a year or more than 5 times if real estate is the security. And this is the slide that I created for you guys to study it, all the information you need to about Regulation Z on this one slide. I showed this slide to you on several other chapters as well. This is the only slide you need to study. It has all the information from this chapter that's spread across, it's spread across, 3 or 4 pages here. And it does it in a clear story line. So Regulation Z is a federal law that implements TILA, the Truth in Lending Act. It requires full disclosure when talking about financing in an ad when certain triggering terms are used. Those triggering terms are the words that are used in an ad that would require the full disclosure of financing terms to avoid indiscriminately promising financing to anyone who sees the ad. You have to discriminate. You have to, you can't promise financing only, to anybody who sees the ad, but only to those who qualify for the financing. So we would have to put out that full disclosure statement that says to those who qualify or to a qualified buyer in that advertisement, along with if those triggering terms are used, along with you have to state the interest. Well, these are the triggering terms that would trigger the full disclosure requirement. The interest rate, a payment amount, a down payment amount, or the term. If any of those things are used in an ad, then you have to discriminate. You have to say to those who qualify or to a qualified buyer. In addition to that, you have to fully disclose all the financing terms, the APR, the down payment amount, if required, and the term. And over here, I give you a little explanation of what an APR is again. I think this slide may be slightly different than the other ones. I got to adjust the other ones in all the other chapters because in here I also explain the interest rate plus any one-time incidental costs associated with getting the loan. APR is always a little higher than the interest rate. Okay. Does not apply to business, commercial loans, cash transactions, reverse mortgages, land loans with removable dwellings, the mobile homes. And if you violate the Regulation Z, the penalty is $10,000 a day for each day that ad is out there violating the law. A misdemeanor is a willful violation is considered a misdemeanor that's punishable by an additional $5,000 fine and up to 10 years in prison. Well, I'm sorry, up to 1 year in prison. All right. So in the book, what to highlight, this is why this one slide is great just to study from this slide. Just take a picture of it, study. It's got everything you need to know, fully explained. Otherwise, this is what you're studying. You got to highlight these things over the next couple pages. There's no right of rescission to purchase real estate for purchase money mortgages, only for loans to refinance. There's a 3-day right of rescission. And then these are the triggering terms. Here's a list of them. Down payment amount, the term, down payment, amount of any payment, okay, monthly payment, and the interest rate, finance charge. And this is the way that it would look in an ad. So they give you a couple examples here. Do you have all these written, already highlighted in the book on page 290?
Yes.
Okay. And on 291, then you had this. You probably already got this highlighted as well, right?
Yes.
All right. And then we have the Equal Credit Opportunity Act, ECOA. This is a law that went into effect. I think we went over this in chapter 4 for discrimination. ECOA was a law that went into effect that was more in effect to prevent discrimination against women when getting financing, because, years and years and years ago, it was discouraged for women to work. So the Equal Credit Opportunity Act prohibits lenders and others who grant and arrange credit from discriminating against credit applicants on the basis of, any of the protected classes. And the lender must inform somebody who's rejected for credit when they apply for credit, the reason why they were denied, and provide them with a free copy of their credit report from the 3 credit reporting agencies. So if you ever turn down anybody rentals because of their credit, well, you got to explain to them, and you got to follow the ECOA law as well. Otherwise, we don't offer financing, so we would never be the ones turning anybody down because of that. All right, so RESPA, the Real Estate Settlement Procedures Act, the Federal Real Estate Settlement Procedures Act, RESPA, was created to ensure that the buyer and seller in residential transactions have knowledge of all the loan costs, all the settlement costs for a loan. That's on page 291. So RESPA, you'll probably get on exams. You need to understand, what is the purpose of the RESPA settlement statement? Well, it's to ensure that the parties to the transactions have knowledge of all the settlement costs in getting that loan. Now, the RESPA settlement statement was formerly called the HUD-1. This was replaced by the CD, the closing disclosure. Remember, I told you Obama created the Consumer Financial Protection Bureau, the Consumer Financial PD, the CFPD, Consumer Financial Protection Bureau. And what they did is they changed the names of a lot of these forms, renamed them, combined some of them. So this was an existing form called the HUD-1. That was the settlement statement when you purchased a property. Now it's called the CD, the closing disclosure. It explains all the actual settlement costs to the consumer, and it has to be provided with at least 3 business days before the closing to both the buyer and the seller. Now, at the beginning of the transaction, they give you a loan estimate. Now, previously, the loan estimate was a document the loan estimate was replacing a document called the GFE, the good faith estimate, which basically did the same thing. They just gave it a new name. And in certain situations where the loan estimate may need to be reissued, that would trigger an additional 3-day waiting period for the consumer. And remember, there has to be at least 7 days between the time the LE is issued and the time the closing takes place. So that would always be there, but this would add an additional 3 days onto that. So if there was any changes made to the loan estimate that would require the loan estimate to be issued. I mean, the loan estimate is issued at the beginning of the transaction. But if later on in the transaction, the consumer changes maybe the amount of money they want to put down or the loan type that they're going to get, well, these are some things that would trigger the reissuance of a loan estimate and an additional 3-day waiting period. And they're all, on top of that, there has to be that 7 days between the time the LE is issued and the time that CD is given. Okay, so this is a good thing about the time frames and the explanation of the RESPA statement that will be on exams. All right. So I got these explanations in here for you, so you may want to snap a picture of this. Otherwise, you could highlight it someplace else in the book. We're going to have it in this chapter as well towards the end.
Wait, which part?
Well, you need to know the real estate. What is the purpose of the RESPA settlement statement? To ensure that the consumer has knowledge of all the settlement costs. You have to know that the former RESPA settlement statement was called the HUD-1, but it was replaced by the CD, and you need to know when it was given. Then you need to know that the LE needs to be given to the consumer within 3 days of their completed loan application. And when is that? Well, when aliens happens, when all that information of aliens has been provided to the consumer, and that the LE is the new document that replaced the old document called the GFE. And that has to be given at least 7 days before the closing takes place. But if the LE is reissued, that's going to add on an additional 3-day waiting period, allowing the consumer to think over whether they're going to close on this loan still. So RESPA, once again, the Real Estate Settlement Procedures Act, is a federal law that ensures the buyer and seller in residential real estate transactions involving new first mortgage loans, that the parties in the transactions have knowledge of all the settlement costs for every penny in the real estate transaction. And it doesn't apply to any of these types of loans. And it's illegal for anyone to get paid in a real estate transaction if it's not disclosed on that RESPA settlement statement called the CD, which replaces the HUD-1. So once again, I have a breakdown of everything from the previous slide, but just put in my own words here on this one now. The loan estimate, LE, is an estimate of the loan costs. It replaces the GFE, the good faith estimate. Must be given 3 days, within 3 days of the completed loan application, aliens, and at least 7 days between the time the LE is issued and the closing. And certain changes may require reissuing of the LE and triggering an additional 3-day waiting period. Now, those additional things that would trigger the 3-day waiting period is on page 297, which we're going to go over, and I just give the cross references to all this stuff on one place. The CD is the closing disclosure. It accounts for all the actual final settlement costs. And this must be given 3 days, at least 3 days before the closing. And it replaces the HUD-1 RESPA settlement statement. So this one may even be a little bit better than the previous slide, because it also gives you the cross-reference to the page that has those triggering those things that would trigger the reissuance of a new loan estimate, which is coming up anyway. It's still coming up. So TRID is the TILA RESPA integrated disclosure. The CFPB, the Consumer Financial Protection Bureau that President Obama created. One of these things that that agency did is I told you, they renamed some forms they combined. Well, here's one that they combined. They merged and modified some of the existing forms that HUD already created. Lenders are responsible for delivery of documents within certain time frames, and they can be liable to paying certain fines or eating costs of the loan if they exceed certain tolerance limitations imposed by TRID. TRID stands for the reason I drink. No, I'm kidding. It stands for TILA RESPA Integrated Disclosure. That combined form. Okay, so the HUD one, the good faith estimate, and older disclosures that have been replaced, they could still be used on certain transactions that TRID rules don't apply to, like those home equity lines of credit, reverse mortgages, loans for movable dwellings, cash transactions, and commercial purposes. And often they are used because the HUD one is a lot easier to fill out than the CD is. So just like I had them both combined in that one previous slide, this is just the explanation of what the LE does again. Lender has to provide, the disclosure when it's got to be given. So let me just skip through this instead of repeating myself over and over. Now, here's the thing that would reissuing a new loan estimate. Situations that require an additional 3-day waiting period and reissuance of a loan estimate on page 297. So let me turn to page 297. Hold on one second. I should take a screenshot of something. Okay, I gotta take a screenshot of this and add it to the book, so, or add the slide. Just find out which slide this is. Okay, so in this slide that talks about slide right here that talks about the types of transactions that TRID applies to. This is on the top of page 292. I don't have a screenshot here for it, but I just highlighted where it says at the top of page 292, TRID rules do not apply to the following transactions. And then I highlighted about the intent to proceed, which transactions what aliens means, and that the loan estimate replaces the GFE. So here, let me just share with you a screenshot of it, I guess, or since I don't have the screenshot of it yet, I just took a picture of it. Let me show you what I have highlighted on this page 292. After I sneeze, sorry about that. See that?
Okay, wait a second.
Yeah.
Trid. The lender. And where do you end it? The proceed. And then aliens.
Yep.
Wait.
Yeah, no, I know the screen's starting to. It's mistaking my yellow highlights as green for the green screen, and is
Oh yeah, wait,
okay.
come back. Come lenders.
Okay.
Where is-
You're
wait.
highlighting what it says. Hold on one second. The lender over there under intent to proceed. The lenders may charge additional fees, such as an application fee, appraisal fee, only after the consumer indicates an intent to
No.
proceed.
Oh, the
Okay.
one at the bottom.
Oh,
Okay, wait, you got to back up because it's doing something else.
Yeah.
Okay, it's the beginning loan and lenders here and applications. And then we got underline within
3 business days.
business days. Places good faith estimate. Okay.
Okay. It's basically the same stuff that I had written on the slides. It's just here's where you can highlight it in the book now. You know, the previous slide I told you was great for that, but this slide and this slide has everything you need to know pretty much on there. Except for the aliens, actually. I don't think I mentioned aliens, did I? Oh yeah, I did. Okay, so everything's
Yeah,
on
you
this
did.
slide right here. I was just giving you the highlights for it there on page 292. And then over here, we're going to go to page 297 to see the circumstances when a new loan estimate must be reissued if certain new terms would trigger that. And these are the things that are listed on 297. If these would trigger an additional 3-day waiting period on the loan and require the reissuance of a new loan estimate. If the consumer requests a change in the loan amount or down payment, the appraisal came in higher or lower than expected. Changes in the borrower's credit score or debts. Now here's a little tip. Buyer's agents should inform their clients, that's you guys, should inform your clients not to make any large purchases, charges, layaways, car leases, or anything like that until after they close on their purchase of the real estate transaction here, because that could affect their credit, and they may no longer qualify for the loan anymore. See, a lot of times people get all happy and giddy and ready to close on their property, and they start shopping for furniture and stuff like that, or they may go out and they lease a car or buy a car because an emergency comes up. Hold off on that. Wait until you close on the transaction, if at all possible, because these types of things could make it so that you can no longer afford to buy the house anymore. They could throw off your debt to income ratio out of whack, and your lender does check your credit multiple times throughout the transaction, make sure nothing like that happens. Often the moment before closing, before they give the okay to release the funds to the closing agent, they do a check on your credit again. And they could say, hold up the phones. You're not authorized to release the money because there's been a change in the buyer's credit. You know, so the buyer's got to be careful that there's no drastic changes to their credit because of things like this. Now, the lender could not document the borrower's pay, overtime, bonuses, tips, or other income, or the costs change for the services the borrower could not shop for. The interest rate changed because the borrower did not opt for the rate lock, or maybe that rate lock expired. Prepayment penalty may have been added, even though New Jersey, no prepayment penalties. That's what you need to study for exams. That deals with institutional lenders. Private lenders can charge prepayment fees or penalties, okay? But for exams, just study no prepayment penalties. But obviously that if it's a commercial loan, well, then that would require the reissuance of a new loan estimate. Now, we know that this does not apply to commercial loans, but second loans, those loans by private investors are considered commercial because they come from private investors when people are using two loans to buy a house. Okay, loan product was changed, or the APR increased beyond allowable tolerances or limits, like 1/8 of a point for fixed rate loans or 1/4% on adjustable mortgages. And all that is once again on page 297, which I once had a screenshot for, but I think I removed them. I did. I don't know why. Let me add the screenshot back for those things. And these are the things that would not trigger the reissuance of a loan estimate. Look at the benefits. That's weird. All right, and they would be unexpected discoveries during the final walkthrough, or necessary adjustments at closing in the commissions or prorations of taxes, utilities, or any other things where they do last-minute adjustments, fine-tuning of things like payments for utilities, taxes, etc. Those last-minute financial adjustments would not trigger the reissuance of a new loan estimate and an additional waiting period. So agents should always advise their buyers to educate their clients in transactions that they don't make any of those large purchases. You know, in this slide, I just put together there's a goof video that a clever real estate agent, she put together something that kind of goofs on this, how we constantly tell clients not to do these things, but yet they go ahead and they do it anyway. So, I mean, it's a clever video in that regard. However, often this video is hit or miss. Sometimes it crashes my slideshow here and my Zoom, and then I need to restart the Zoom application. So I don't know if I should play this video right here. You guys may want to look at this on your own.
Try it. Try it.
Well,
you can always sign back in.
If so, I got to restart the Zoom application here and then come back into the class. But it's a goof where an agent, she just goes on she goes on talking about some of the common things, and she does it like a reenactment with some friends posing as clients, you know, and they talk about some of these things, these issues that we coach people on. And some things we come across, like the old lock boxes that they get frozen in the winter, and she's like coming at the thing with a hammer, a sword, and all kinds of stuff like that. It's a really neat, let me see, what the hell. Okay, keep your fingers crossed.
Gemma, I've really been thinking about getting into real estate.
Right?
It seems like you've got such a flexible day. You
Yes.
can drive around all the time and make your own schedule.
Right.
It seems like fun.
You know, let me also put up there that optimize for video clip. Hopefully that'll help as well.
Fun and easy.
Gemma Leggett, bonjour. Tomorrow morning as on Christmas Day? Yeah. Okay, I gotta pull up this address. Oh, come on.
You gotta love that when you're showing a house and you can't, and the house does not come up on Google Maps or any of the mapping softwares or GPSs. You gotta love when that happens. There are properties out there that just simply don't come up on the maps. That could be frustrating. Or this one, this is the one with the goofing on the lockbox. You can't get it open, those old combination lock boxes that you could still find, and some agents are using them sometimes. We have to use them on like HUD properties and listings and stuff.
I mean, you get to look at all these amazing houses, and everybody's staging right now, right?
Yeah, most of them do. And this is the master bed. I'm sorry, we're not going to see this.
I mean, you get to work with people, and I love people. I'm a people person.
Gemma, we have some exciting news. We're pregnant.
So we have to stop looking at 2-bedroom houses and we have to start looking at 4.
But we have the same budget though still.
All your clients have to do is love the house, and then they buy it.
Gemma, this house is perfect.
Right?
Yes, totally. But I feel like there's a but.
But we've only seen 87. I think that we should see some more. It needs to be perfect.
So we did it. We found you the perfect house. This house is at market value. Okay, so they're asking $648,000.
So let's offer them $400,000.
Yeah.
Okay guys, we have received the home inspection report. So everything is good. We can now remove our conditions.
You said if we find something wrong, we could walk away or negotiate with them, right?
Right? What is wrong?
Well, the lights were too bright.
The paint?
I didn't like the doorknobs.
It's just the atmosphere.
And the windows were kind of dirty.
It's really messing with my feng shui.
I get to see you some.
By the way, reasons for backing out once you place an offer in are not because the paint is messed up, the flooring, you don't like the flooring, or there's a hole in a wall or something like that. Those are not reasons to back out. Those are cosmetic issues. Cosmetic issues are not a reason to back out of a transaction.
Media account and all of those happy people. I want to make everybody happy.
Guys, picture! Hey guys, we're happy. We just bought a house. Take a picture. Yay, cheers! Cheers!
So that's fine, but that's not a thing. No, thank you.
No, thank you. I mean, it's an easy job, and you get paid so well.
Okay guys, so the process is done. So from now on until closing, make sure that you're not buying anything, any big purchases on credit.
Obviously.
Okay, so no boat, no vacation, no cars.
Come on, Gemma, we're not dumb. Gemma, what do you think of our new car?
Isn't it great?
You paid cash, right?
It's got a wicked 1.5% rating.
Yes, you know what? Honestly, I think you're going to love it. Would you like me to get you my books?
Sure, yeah.
Yes, do that.
What, you have to study all this just to sell houses?
Anyway, it's a cute little video together, goofing on some of the issues we come across commonly with people. And you can tell them till you're blue in the face, and they're still going to do whatever the hell it is that they do, you know? So it's, I think it's a cute video. It actually goes over some of those things. So here are the timelines once again, a breakdown of these timelines again for the documents. First of all, aliens. Everything starts with aliens. You know, when the aliens have landed, when the consumer provided all the information that's required of the loan applicant, aliens. That's the acronym to remember all that stuff. And remember, that was outlined on page 292. Then the loan estimate must be given to the consumer within 3 business days, as well as the Your Home Loan Toolkit. And remember, if there's a reissuance of the loan estimate, a new 3-day waiting period is added onto that. And there has to be at least 7 days between the time the loan estimate is given and the time the closing occurs. And then for the CD, that's the actual closing cost, not an estimate of it. There has to be at least 3 days before the closing that the CD is given to the consumer, both the buyer and the seller. That's a final statement of all the actual closing costs. And then any buyer should compare their original loan estimate with the CD to make sure that there's only certain tolerance limitations that the lender can be off by. If they're off by more, I think it's like 10%. If they're off by more than that, then the lender has to eat those costs. So this, I got the page numbers here and the timelines and such, again, all in one slide. If you wanted to snap a picture of that, be my guest.
Got it.
Okay. And then this is the last page, 297. I think this is the last page. Yep, 297. You know, what is a business day? I keep saying at least so many business days. Well, there's two definitions for a business day under the CFPB. Two definitions exist for a business day. One definition of a business day is any day the lender's open for business. And the other definition is any calendar day except for Sundays and federal legal holidays. So depending on the creditor, Saturdays might or might not be considered a business day. There you go, clear as mud. All right, so the loan estimate, just write LE above that, and then replaces the GFE, the good faith estimate. This stuff will be on exams. Don't shoot the messenger. You know, they created these new documents that replace the old ones, and for exams, you need to know what the old documents are called, what documents replace them, and what they do, and when they need to be given, those timelines. Okay, you do need to know that for exam. So the LE has to be delivered or placed in the mail no later than the 3rd business day after the lender received the completed loan application from the borrowers, aliens. And there must be at least 7 business days between the delivery of the loan estimate and the closing. And if it needs to be reissued, an additional 3-day waiting period.
How does that affect the right to rescission?
Well, that's why there's an additional 3-day waiting period.
This should all be done before that, right?
What's that?
I said this should be all done before that, right?
Well, the 3-day rescission period you're talking about is with attorney review at the beginning of the transaction. This is talking about the loan, not the contract for the purchase. This is talking about the loan for the financing. So the consumer could be, in certain instances.
So this should be after, like.
Oh, this is way after the initial attorney review. Yeah.
Okay. So you've already accepted it, and this is like after.
The borrower is now putting in that loan application with the lender, supplying their, credit report, pay stubs, bank statements, all that stuff. Applying for the loan, the lender gives them the good faith estimate, or the LE now, and if there's any terms later on in the transaction that may require the reissuance of the loan estimate, well, then that would just trigger an additional 3 days on the waiting before you could close, so that the consumer can evaluate the new terms to see if they want to go through with that. Now, the CD is the closing disclosure. That replaces the HUD-1, and that has to be given at least 3 days before the closing.
Three days before the close. 3 days before.
Yep.
Three days.
Yeah, it says that right over here. No later than 3 days before the consumer signs the loan.
And you put at closing?
Yeah, because when does the consumer sign the loan? At closing.
So
You sign all those mortgage documents at closing, right?
Yeah, but if it's at closing, why is it 3 days before? Because the closing is right
The
then and there.
actual-
So
The actual closing costs, that should have been prepared beforehand, and you should have
right.
information available to you at least 3 days before the closing.
Okay. So
Then
you
the
can have the numbers done and know that the numbers are right or anything
Yeah,
like that.
yeah. And then you can review it all. And then the lender will prepare the actual contracts with everything and prepare them and send them over to the attorney or whoever's handling the closing so that the consumer can sign it at the closing table later. Because remember, when initially getting a loan, there's no such thing as digital signatures. When initially getting a loan to buy real estate, it has to be done with a pen, wet signatures. You need to sign those documents still. The only loan documents you don't have to actually sign, you could have digital signatures on. And that's for most of the paperwork, but not even all of it would be for refinancing. Even when you refinance, there's some documents you need to sign.
Wait a minute.
Okay, you guys got all this or still writing?
Yeah, I got it. You got it, Ray? Ray? You there, Ray?
Ray.
Yeah, everybody, I'm sorry.
Okay. All right, so that's that for chapter 15. Let's do the key terms to review, and then we'll kick in with chapter 16. All right, so key terms to review. Let me pull them up while I pull up chapter 16. So, key terms 1, page 299. Are you ready? Hope so. Ready or not? Here we go. Mortgage covering more than one parcel of real estate. What do we call that?
A. Blanket mortgage. I'm
A
sorry.
blanket mortgage, one is A. A mortgage covering both real and personal property. Mortgage covering both real and
personal property.
Mm-hmm.
Jumbo loan?
Nope.
Construction loan?
Nope. What kind of loan covers the purchase of both the real estate and the property?
No.
Home
A package mortgage.
13 is B. Correct. Cooperative organization for members who save and borrow.
What? Cooperative organization.
Hold on. Ray, you gotta mute yourself when you're not talking, okay? And then just unmute yourself, hit the keyboard when you're not, when you are talking, okay?
Would that be an open-end mortgage?
Let me see, we're cooperative organization. No, cooperative organization. They're not looking for a mortgage. They're looking for a cooperative
Credit union.
For members who save and borrow, that would be a credit union. 3 is C. See, these key terms, there's hints in them that give you an idea of what they're looking for. This will better help you if you pay attention to them a little bit. They give you hints and clues, and the better you get at looking at doing these things, the better you get at answering these exams and looking for what exactly they're looking for in that question. So 3 is C. A privately owned corporation that sets standards and buys mortgages. Look, in the book, they didn't refer to it as a privately owned corporation anymore. They referred to it as a shareholder-owned corporation under congressional charter.
Mortgage banker. Oh, that's not it.
Fannie Mae?
Fannie Mae. There's D. Correct.
Thank you.
Federal Home Loan Mortgage Corporation warehouses packages of mortgages originated by member savings and loan associations.
Freddie Mac?
5 is E, Freddie Mac. Government National Mortgage Association pools mortgages for investors.
Jenny Mae.
That's Fanny's ugly stepsister because she takes those risks, right? 6 is F. Additional financing for homeowner, usually a type of second mortgage.
Construction loan.
Construction, to construct, to make new. That's the first loan, right?
That's G for 2. 2 is G.
Mm.
Oh.
I said a construction loan is the first loan. It's to construct, to make new, where there is nothing. So it's not a second.
Home equity.
Home equity loan, 7 is G, correct. A loan with interest only, typically for less than 6 months. Those interest only loans for short-term financing.
Interim financing.
Interim financing, 8 is H. Loans higher than those usually bought by secondary markets.
Open-end mortgage.
A loan that is higher than those usually bought by the secondary market.
Jumbo loan.
Jumbo loan. 9 is I. Agent who makes real estate loans for one lender. I'm going to add that to the end of that definition. An agent who makes real estate loans for one lender.
Mortgage banker.
10 is J, the mortgage banker. You may want to write that at the end of J, though, for one lender. Otherwise, it's not that clear. Agent who brings together lender and borrower for a fee. And they can work with many different lenders.
Mortgage broker.
Mortgage broker, 11 is K. A mortgage that provides possibility for further borrowing.
Open-end mortgage.
Because you never close it out. So you could keep borrowing off of it once you build equity. 12 is L. A straight loan for short-term building period.
Construction loan.
Construction loan, 2 is M. All right, key terms 2. Lending institution that makes mortgage loans to the public.
Wait, what? Wait, lending institution.
Lending institutions that make mortgage loans to the public are referred to as, where do you get loans from to buy real estate? What do we call that? It doesn't matter who you're getting it from, but what do we call it when you get loans to buy real estate?
Primary mortgage market.
That's the primary mortgage market. 2 is A. Loan not intended for resale on the secondary market.
Dag on it.
Who makes loans and they don't plan on reselling them in the secondary market? So therefore, they don't have to follow. They're not influenced by anybody's third party's opinions or guidelines or influence.
I don't know. Purchase money mortgage. I don't know. That doesn't sound familiar.
Portfolio lenders. It's a
Oh yeah, they're building their portfolio. That's right. Okay.
Yep, they plan on keeping those loans in their own investment portfolio. 1 is B.
Seller finance.
Seller financing. At the end of that, I have written any loan to buy real estate. So it's not just seller financing, it's any loan to buy real estate, which includes seller financing.
It's what? You broke up for me. You're what?
Any loan to buy real estate, which also includes seller financing.
Purchase money mortgage.
Yes.
Oh, okay.
3 is C. Arrangement by which a seller becomes a tenant. A seller becomes a tenant.
Wait a minute. Say it again. It's
What do we call it for a seller, an arrangement where the seller becomes a tenant?
Shared equity mortgage.
That's a
Oh, lease back,
Be more specific, please.
sale lease back.
Sale leaseback, 7 is D, correct. Process of deciding whether to make a specific loan. What do we call that process where a lender decides?
Underwriting.
Yes, it's called underwriting, correct. 11 is E. Words in an ad that require full disclosure of financing conditions.
Words in an ad.
What do you call the words in the ad that would require full disclosure of financing?
Would that be Regulation Z?
No, what? It's associated.
Wait, back
Truth
to
in
back to
lending.
underwriting. I know you said it's the process of deciding whether to make a specific loan, but can underwriting also be like analyzing the property to see if you want it or not, or no?
No, under the process of the lender determining whether to grant a loan.
So what if you was like running comparables, like you're like running the numbers, like what would that mean?
Well, that's what a lender does. That's called underwriting. It's a process of underwriting. Analyzing the risk of the lender. Where the underwriter works for the lender, and that's the process of the underwriter's job is to analyze the risk to the lender. And part of that is they analyze all the buyer's information, all the property's information, and determine if they're going to grant the loan or not. They analyze the level of risk, and then they're going to decide whether they're going to grant the loan or not, depending on whatever that lender's guidelines are. So that's what underwriting is. But we're looking for right now is words. What do we call the words in an advertisement that require full disclosure of all the financing conditions? What do we call those words? Nope.
No, not the Truth in Lending Act.
Nope, but it's associated to it. But what
I said Regulation Z.
Those are the laws. We need to know what the words are called that would require that full disclosure. You're quoting the laws that require that. What do we call those words in the ad that require that when you see these certain words? What are these certain words called? Triggering terms.
Don't tell me. Don't tell me.
I just told you.
Triggering terms. I don't want you to tell me.
Too late.
Triggering terms.
9 is F. Triggering terms.
Didn't get that.
A percentage of income borrower may spend on housing expense.
Qualifying ratio.
4 is G. A mortgage in which the lender sends regular checks building up debt.
I saw it. Where is it?
Hold on, think about it for a second. A mortgage where the lender sends checks regularly, building up debt.
Shared equity.
The lender sends the checks.
Wraparound mortgage.
Hold on a second. Who usually sends?
Reverse mortgage. It's a reverse mortgage.
Reverse mortgage.
Reverse mortgage.
You got to slow it down a bit because when you just grab onto those answers and you go with them, you do that. I mean, I realize there's a lot more answer options here. But like on exam, you're going to get those questions wrong if you latch onto an answer really quick. You know, you got to take your time analyzing them. Okay, you got 4 hours to take these exams. Remember, don't be in a hurry. So which one did we just do? Okay, a mortgage in which the lender sends regular checks building up.
We're on I.
Reverse mortgage. 6 was H. That was the reverse mortgage. Okay. Now, loan in which the investor shares payments and profits.
Share equity mortgage.
8 is I. Correct. What implements the Truth in Lending Act?
Regulation Z.
Yes, 5 is J. regulates consumer loans.
Oh man. Okay, we got
Requires the full disclosure when those triggering terms are used, according to Regulation Z.
Hold up. Don't say the answer. Don't say the answer. I'm trying to figure it out. You got it, Ray? Ray, do you have the answer?
Nah, I don't know.
Truth in Lending Act.
Let's see.
10 is K.
Aliens?
Nope. Truth in Lending Act.
10 is K.
Yep.
Oh, wait, I thought we did that already. Well, okay. That's probably why I didn't even see it because I got something written in here.
So
Okay, 10
basically,
is K.
yeah, I mean, Regulation Z implements Truth in Lending Act, which requires full disclosure when talking about financing in an ad when certain triggering terms are used. So all three of those things were related, but you got to remember the spiel behind that, right? So 10 was K. Larger loan that does not disturb the underlying mortgage.
Wraparound.
A wraparound mortgage. 12 is L. Merges the TILA and the RESPA disclosures.
Triad, TRID.
The reason I drink. TRID. Yeah.
TRID.
Yeah, stands for the reason I drink.
That's
or TILA RESPA integrated disclosure statement. Yes.
Okay.
So 14 is M.
Okay.
Detailed loan costs. Where are they outlined?
Loan estimate.
In the loan estimate. 15 is N. And required items before lender can proceed.
Requires items before aliens.
Yep, aliens. Then when the consumer completes their loan application, alien provides all the information of aliens. 13 was O. And that is it for that. Let me just close that out real quick.